At BP, so we'll continue to focus on that here at Bloomberg. Also keep an eye on Hayes, away from the stocks listed on that graphic. This is a recruitment business, and if you're ever looking for cracks in labour markets, always a useful one to watch. And there's a bit of a warning there around their revenues. Guy?
Yeah, the labour market does seem to be a significant story. Certainly was yesterday for US markets, maybe here in the UK as well. Right, here we go. Friday session is almost upon us. Are we going to see significant movement at the get-go of trade? Let's find out. It's time for the opening trade. These are the initial numbers, and it looks as if London is struggling for a sense of direction already. Let's see exactly where we go with this one. Nobody is expecting these markets to deliver a surprise at the start of trading today, but there's plenty of things for markets to worry about and think about right now. Maybe just not today. Maybe we've got a quieter session in prospect like yesterday. So here we go. Stock 600 barely budging. FTSE 100 barely budging. The IBEX is down by 0.1%. The DAX, which seems remarkably out of the gate, remarkably quickly out of the gate this morning. Clearly nothing going on there because it usually takes a while if there are things to price in. So yeah, Critty, you can save me now.
I'm going to toss it quickly to Anna in a moment. But when you look at the FTSE 100, I think what's interesting here is even though on the surface there may be not much happening, commodities are the underperformers, not just in the oil sector, where you are seeing BP and Shell, your biggest weights on the index. BP taking a beating this morning, down about 1.2%, which we'll dive into in a bit. But you're seeing some of the commodity names as well as even some of the other trading platforms. Glencore, for example, also trading in line with the commodity space. When you look to the other side of the coin, which is, of course, the biggest gainers or the biggest index contributors to the upside, it's Novo Nordisk, it's ASML. It kind of almost feels like on the surface a little bit of a safety trade. That oil move seems to be the biggest one, just following what you're seeing in the broader macro space.
Yeah, I'm just being, our attention is being drawn by our colleague Oliver Crook to the lines out of Porsche this morning. And Guy, you were talking to Ollie earlier on about the travails of some of the big German manufacturers, particular upper-end cars. Well, Porsche's China sales numbers, they're now out to go alongside the ones from Mercedes yesterday. Porsche's sales plummeting in China during the third quarter, a decline in luxury spending, of course, that we've covered a lot, a shift to local electric brand cars, all of that weighing on this business. So China deliveries fell by 19% in the third quarter. This comes on the back of BMW, Mercedes, also reporting steep quarterly declines in the Chinese market.
You also got to think about this in the fact that the EV landscape seems to have leveled the playing field in many ways. You think about a Porsche 911, you think about that kind of a vehicle that has some sort of iconic status, but does the Taycan have the same iconic status? Is it more comparable with other EVs in terms of what you get, the performance you're looking at, that kind of stuff? So it does feel as if the EV landscape is, and the transition makes it more difficult for some of these legacy car makers.
Puts a different complexion on the brand, perhaps, and what people are think it's worth paying for that brand. One of our colleagues at Bloomberg Opinion writing just yesterday about the domestic fight back in China. And yes, it's been at the lower end with entry-level EVs, reasonable price, the things that Europe doesn't necessarily have so much of. But now actually increasingly focused on the upper end and trying to reclaim some ground within that space. So interesting to watch as the Chinese offering around autos evolves.
We should mention the underperformance in the French index as well. And we're still waiting for some of those numbers to shake out. But you had warned us of this earlier. So had Joe as well. LVMH is taking a beating as well, down about 1%. Sanofi, Total, basically your biggest French names, reacting, underperforming, perhaps in reaction to that French budget.
Some of those 440 companies, perhaps, that will have to pay more tax as a result of this.
Precisely. But let's also think about the fact that LVMH has been moved around an awful lot this week by the China story. We have a briefing tomorrow, I think, from the Ministry of Finance. We've got another briefing coming up at the beginning of next week. Could the story around LVMH change by Monday morning if the Chinese come through and deliver significant amounts of stimulus? Does that read through into the European luxury names where we aren't seeing it in the car sector this morning? That certainly is a factor that we are going to be watching out for. Let's talk a little bit about kind of what is happening with some of the risks that we're watching in these markets as well. We factored in China. We've talked about the tax story here in Europe, but the big story that is hanging over everything right now appears to be the US election, and that's what so many investors are focused on. Nouriel Roubini was talking us through his take on this yesterday. Just take a listen.
I worry that regardless of Harris or Trump, that over the medium term, we have a number of negative aggregate supply shocks that are meaningful. Deglobalization, reshoring, friendshoring, aging, restriction of migration, geopolitical conflict, climate change, pandemics, backlash against the liberal democracy. All these things tend to increase cost of production, reduce growth, and there is stagflation of the medium term. So some of my arguments are independent of whether Harris or Trump will be elected.
Nouriel Roubini there speaking over in the States to our colleagues at the U.S. Open. Let's get another take here. Kristen Bitterly, head of Citi's Global Wealth at Work unit, joins us now around the table. Good morning. It's lovely to see you. Welcome back to London. We're talking a lot about the digestion of geopolitics, of course, in Europe and how that affects things. As Guy said, the overhang is the U.S. election. As Nouriel Roubini said, the overhang is the U.S. election. How do you trade it?
So U.S. elections, I think, we have to take a look at the macro backdrop in terms of why U.S. investors are actually quite bullish. And so we've been visiting with a lot of our clients, and the general theme is, okay, if interest rates are coming down, if we're seeing disinflationary forces, if we're seeing record corporate profitability, and then you add things like China stimulus on top of it, it's a very, very positive macro backdrop. I think one thing that we could see within October is just the fact that October in any election year tends to be a negative month. It's just trading that uncertainty and saying, I'm going to take some of my money, some of my gains, particularly in a year like this, off the table. So I think over the next couple of weeks, we could certainly see that. We're seeing that in the options market. When you look at skew within the options market, people are hedging going into this month. So I think waiting for the outcome of the election, and generally once we know that outcome, we tend to see a rally into year end.
You mentioned the China stimulus as well. We'll circle back to the election. But you mentioned the China stimulus. How similar from a trading impact is this package that we're getting relative to the massive influx that we got back in 2009?
So I think it's very different in the sense that we need to wait and see, because two things we need to look at within the Chinese economy as to whether or not this is going to be strategic as opposed to a tactical trade. And so for it to be strategic, you need really two things. You need consumption to increase in that economy. There are various measures that they're taking, but time will tell until we actually see whether that spending manifests. I think the other thing, too, is international investment. One of the massive trends that we've seen over the past couple of years is international capital moving away, going into other parts of Asia, or just the global economy and global markets more broadly. We haven't seen that come back in. A lot of the movement was short covering and local market activity, and we need international investing for that to really have legs.
Yeah, and Chris, is fiscal stimulus, yes, you've mentioned we need some of that, maybe that's part of the story, but that flow of money was made nervous by broader policy. It wasn't just a sluggish Chinese consumer, I assume.
Yep.
So is fixing the Chinese consumer going to be enough to encourage that money
it has to
that
be
went
a
elsewhere?
and it has to be a multi-pronged approach. So when you're looking at everything that they're doing right now to encourage stock buybacks, to stimulate the local economy, I think it needs to hit on all fronts as opposed to just being one element. But consumption is something that everyone's looking for, and that's what's been missing.
Yeah. Back to the United States, how has the cut in 50 basis points sort of triggered conversations with clients? How are people thinking about a slightly lower rates environment? And jury's still out about how quickly those rates come down. But how is that changing the conversations you're having with clients at this point?
So I think cash was a viable asset class for the past couple of years as we saw interest rates go higher and higher. I think now the conversation around, can I continue to generate this yield simply by rolling T-bills? Do I need to actually find other types of instruments within the fixed income market is now becoming a reality, because it's not just the 50 basis point cut, it's what's the trajectory from here. So if you're someone who's been significantly overweight cash. How am I now reallocating that portfolio to have more of a sustainable yield? And I think that's why we're going to see a continued tailwind in terms of the equity markets as well. So with record profitability, with lower interest rates, with a disinflationary environment, and a lot of cash on the sidelines now being mobilized, I think that's what a lot of people are thinking about.
Are we sure rates are coming down? Are we sure inflation's beaten?
Well, I think when we talk about volatile markets, the U.S. rates market is probably one of the most volatile.
We're back about 4% now.
I know, on the 10-year, which is actually, adding exposure there could make some sense. I think the thing that's most important is the trajectory. We could debate whether 50 basis points was the right thing, the wrong thing, should have been 25 basis points. Are we going to get 2 more 25 basis points cuts this year? We could debate that, but I think it really is the trajectory, which is why the data, particularly inflation, you had a little bit of a mixed bag. I think owners' equivalent rents coming down is something that's actually a positive signal. And now it's all eyes on the labor market. If we're in this holding pattern, and we saw a lot of Fed speak this week to this point, if we're in this holding pattern, this is the sweet spot. So I think continuing on a 25 basis point cut trajectory is what we anticipate.
Okay. If you're thinking about kind of what you do next, you've got some cash, it's been in a money market account, you're thinking about allocating it. Does it stay in the United States? Does it go elsewhere? Is the argument, again, where is the argument about moving money out of the States?
It's hard. It's a hard argument. I think there's such a natural home bias within U.S. investors more generally. But then when you look at all of those factors, those are tailwinds for the U.S. equity market. I think outside of the U.S., there are certainly opportunities, but it's more idiosyncratic.
How are you feeling about Europe?
So I think that's an idiosyncratic story, actually. I think when you look at some of the growth numbers, not as compelling. You look at that relative value. You could always make a case for valuations, that there would be a stronger case for investing in Europe from a valuation perspective. But I think when you look at the opportunities, when you look at delivering earnings growth, if the U.S. continues to deliver from an earnings growth perspective, you'll see more flows come into the U.S.
What sets it apart, though? Because so many European companies, these major houses, have, say, 60, 70% of the revenue based in the U.S. consumer, and that's kind of been fueling this catch-up trade story. So is it just that the margin growth and the pricing pressure is higher from U.S. corporates? Is that the value add?
I think it's also when you look at how people are accessing the European market, whether it's the UK or broader European market, it tends to be in index-based instruments. And so you have such a strong bias towards more of the value part of the market as opposed to the growth market. And so that's why I think if you're going to access this region more broadly, those idiosyncratic active management makes sense, because there are some great, to your point, global companies. When you're looking at their exposure, is it uniquely to the economies in Europe or is it global?
Guy made a key point of that. We're above 4%. We may continue to see an uptick in inflation. You made that key point that it's the trajectory that matters. If we start to see early signs in the data that actually inflation is decelerating the deceleration is decelerating. So basically the margin of the move is smaller than the market expected, or there's even these tiny upticks in inflation. How do you trade that?
So I think trading it is not actually where you want to go. So when you look at this data,
how do you hedge it then?
Yeah. So I think from a hedging perspective, I would say be very balanced within your portfolios, and you see this within our portfolios as well, that we have, while we are overweight equities, we have fixed income exposure. It is moving out the curve a little bit in terms of intermediate duration, and it is taking advantage of tools even like preferreds, where you're getting an above market yield. But I think when you look at the economic data, there is a lot of noise in it. So we could find something good in that CPI print. We could also say, the fact that airlines are now higher when we're looking at airfare pricing, is that something that we should really be concerned about? And look at the jobs data that we've just received. You have jobless claims ticking higher. You had a monster jobs report come through just recently. So I think we have to look at overall trend, not just one data point driving that.
What's your degree of certainty in being able to pick that trend right now? The world feels really super confusing compared with previous periods. It really does. I'm looking at a labour market that I'm finding hard to read. Inflation, who knows what's going to happen there? You've got a US election coming up. China stimulus, we don't know what that's going to be on a day-to-day basis. There seems to be a lot of moving parts right now.
I go back to what I said at the beginning of this conversation. You have to basically look at what you know to be true. And if you're seeing record profitability, you're seeing a lot of cash on the sidelines, you're seeing an overarching disinflationary trend, and rates, for the most part, are coming down. So that is all conducive to being invested and to risk assets.
Chris, great to see you. Thanks very much for stopping by. Always nice to see you in London. Chris Bidley, head of Citi Global Wealth at Work. Thank you very much indeed. Core 6 looks like this morning. This is what the centre of gravity looks like here in Europe. It is a market that is struggling to find a sense of direction, but you're getting a little bit. LVMH is down. Is that a reaction to the French budget, or is that a reaction to Chinese stimulus? So the details we are waiting for. Ferrari's a little soft. Look at Porsche's numbers this morning, particularly out of China. ASML, though, is a little bit more positive. Is that because potentially we are seeing AMD making some moves? I don't know. I find that a little bit of a struggle, but maybe that is why we're seeing some outperformance coming through from the chip sector this morning. But here in Europe, I think we're struggling with a sense of direction. There are some really interesting single stock stories there this morning. Joe Easton has them.
So we are seeing some weakness in BP at the open of trading in London. Remember, we had that trading statement a few moments ago from BP talking about weakness in some of their refining margins. Also just production pretty much flattening out quarter on quarter. But that is kind of in line with what we've seen from the other firms and the analyst research recently with the decline in general in the oil price. So that one, a bit of a weight on the FTSE 100 today. Then in terms of some French stocks, now we mentioned luxury, travel, retail, but an analyst contact very kindly flagged that these are some of the most exposed companies to the French tax increases. So they were looking at Safran and Dassault over in aviation, and Fnac Darty in retail, also Eiffage in construction. But as we can see, pretty much remaining quite steady in terms of the reaction there. So potentially this does now look to be priced in by most of the market, but worth keeping an eye on a number of those French stocks. Then in the UK, some decent declines in both Sainsbury's and THG. Share placings for both of these. Sainsbury's is the bigger one, about $400 million worth of stock being sold by the Qataris, long-term investor in that one. And THG is going to be spinning off its Ingenuity platform. Now that's the BTC retail platform, and they are doing a share placing as well. Cab Payments, meanwhile, now do not trust this price at all, because that stock is going to rise because it is a takeover offer. They've got a takeover bid from a US rival. This is a payments processing firm, cross-border payments, got a bid last night from a US rival, another American company coming to Europe, buying a stock that's listed over here. So we'll wait to get a price on Cab. It was priced in terms of the deal at $145 a share. We're only trading at $121 yesterday, so keep an eye on that one. Then in terms of ratings, a couple of China plays over at JP Morgan. Firstly, they downgrade ArcelorMittal, saying that the company is at risk of potential US tariffs, something we touched upon yesterday alongside that JPM note. Now they are adding Arcelor, and also becoming more bearish on chemicals. So they downgrade Lanxess over in Germany today, and this one is declining as well. That was down a couple of percentage points on Lanxess, ArcelorMittal as well. And another stock is Thales. This one downgraded over there's Lanxess coming down 2%, a decent move on that JPM note. Finally, just Thales over in aerospace, downgraded at Berenberg. That was due to their aerospace satellite division weakening. It's also exposed to defence. There's Thales on the screen, downgraded to hold over at Berenberg, and that one's down 2.6% over in Paris today.
Joe, thank you. Joe Easton from our equities team with an update on some of the movers this morning. Coming up on the programme, more corporate news flow. Sanofi confirms it's in talks with CD&R, Clayton, de Villiers and Rice in what could be one of the biggest deals of the year. More on that next. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
20 minutes into the session, this is what the picture looks like. It's very exciting out there, as you can see. We're a little softer on the CAC Quarante. I think the tax story is certainly rippling through the market this morning. You are seeing it maybe focused on some key stocks. It's interesting, the aviation sector in particular. Take a look at what is happening with what they're doing, for instance, on private jets. That's interesting. That's being taxed. That is a change, and you're seeing it reflected in some of the stock prices as well. But the luxury names are under a little bit of focus too. One stock that does stand out in France, though, this morning is Sanofi. So let's focus on pharma and potentially one of the biggest deals of the year. The company has confirmed that it has entered into talks with CD&R to potentially sell a 50% stake in its consumer health unit. Any deal expected to be worth around 15 billion euros. Eric Fanner, Bloomberg Managing Editor for Global Business, sitting next to me to discuss all of this. In terms of why they're doing it, this seems like a fairly well-trodden path now. We've seen GSK and other businesses doing this. Is this the same? Is it just basically the consumer and the pharma units going in different directions? Because they're fundamentally different businesses.
Exactly right. I mean, we've seen, as you said, a whole series of these deals. We saw GSK, Novartis, Pfizer, J&J. They've all gotten out of these mass market consumer goods businesses where they're selling over-the-counter things like toothpaste, pain relief, those sorts of things. It's a very different business model from developing innovative therapies, which takes years, lots of investments in small biotechs, and we're seeing a real shift away from the kind of mega mergers that we saw, the consolidation in the industry for years that developed these big consumer arms alongside the innovative pharma sides.
It's interesting, Eric, the way that this is structured and who was after it, because they're talking about a 50% controlling stake, so it's not a sort of full offload as we've seen some of the others do. And there was a lot of PE interest in this, wasn't there? There was a lot of competition.
There was indeed, yes. It was a process that went on for about a year with PAI and CD&R at the end. Interested obviously helps for the seller if you've got that kind of competitive interest. That's hence the 15 billion valuation.
Does this pave the way for others though? Or is this kind of a one and done deal?
Well, I mean, we still we'll see more coming out of this one potentially because PE is not necessarily a long-term owner. So we've seen companies like Halion, formed previously from the GSK spin-off.
Why did they go down that different route? Why did GSK look at the spin rather than the sell?
Yeah, that's a good question. I mean, I think some of it might have to do with market conditions at the time. You know, if they had PE interest, in this case, there's slightly different businesses. I think, you know, Halion has maybe slightly more recognizable brand names, some well-known brand names. It's a slightly bigger entity, potentially, so it could stand alone possibly more easily. But, you know, no matter what, deal-making in this sector, we'll see some consolidation probably from these consumer health operations as well, so there'll be more deals to come.
Eric, thank you. Thanks for the briefing. Bloomberg's Eric Fanner with the latest on that particular deal. Let's go from that to the chip sector. Shares in AMD fell the most in more than a month in yesterday's trading session after it unveiled new AI chips but failed to provide the information on financial performance that investors had been hoping for. Bloomberg's Peter Elstrom joins us on this particular story. Peter, good morning. So what did AMD say about its new AI chips? Because I mentioned the disappointment and the things they didn't say, but what did they say about their chips?
That's right. It's not just AMD and its investors that were waiting for this announcement. Really, the whole AI industry is waiting to hear what AMD is going to do here. That's because NVIDIA has essentially a monopoly on the highest-end chips here. It has 90 or 95%. That means that everybody has to pay premium prices in order to get these AI chips that they use to train the AI models that they're using. They want some competition so the prices can come down, innovation can rise. AMD introduced a new set of chips. Lisa Su talked about it. She came on Bloomberg TV to talk about the MI325 chips. She claims that they are more powerful than NVIDIA's high-end chips. But what investors were disappointed by here is that they didn't get more precise details about what demand is going to be like for those chips over the next couple of quarters, what customers are picking up their chips. They want to see that AMD is a real competitor to NVIDIA at this point.
Well, one of the criticisms of NVIDIA by the regulators is that the barriers of entry are simply too high for another player. But NVIDIA and AMD have traded as opposites in so many ways. What barrier of entry does AMD need to surpass, given they, even with those comments from Lisa Su, said we are seeing unstoppable demand?
Well, they're slowly making progress, and there are several different barriers. One of the biggest issues at this point is that NVIDIA is pushing the envelope, pushing the pace so rapidly. They've stepped up innovation to bring out new chips every year, sort of like a consumer product. NVIDIA, Jensen Huang, are very aggressive in terms of trying to dominate this market. That's why you've seen their share price really explode over the past couple of years, up to more than $3 trillion at this point. AMD is pushing hard to catch up with them, but they're quite far behind at this point. And of course, there are dozens of other competitors that are also trying to compete with.
Is NVIDIA's strength in its chips or in its ecosystem? Because it has a much more closed-loop setup. It controls kind of the stack completely. AMD's going down a different road.
Yeah, that's exactly right. NVIDIA has been able to build this ecosystem, you're right, because not just the chips, the hardware that they have, but also their CUDA programming language has been able to tie in a lot of the customers that are using these things. Now, people in the industry do want to have alternatives. They want to have lower-priced devices, so even companies like Google would be developing their own chips to be able to operate the AI systems that they have, to be able to bring costs down, but NVIDIA is still very far ahead of the competition so far.
Peter, nice to see you this morning. Thanks for stopping by to update us. Peter Elstrom, joining us, our executive editor for Global Technology. Coming up, we're going to turn back to taxes, away from tech. We're going to talk about the French government. It has unveiled plans for a significant tax hike. It's got spending cuts. All of this, obviously, is now being priced into the bond market. We're not getting a big reaction at the moment, but the market feels like it's on tenterhooks right now. Benjamin Hadid, France's Minister Delegate for European Affairs, is going to be joining us very, very shortly to discuss all of this, and we'll try and put this in a wider European context for you as well. That is coming up. This is Bloomberg.
dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is the opening trade. We're at 30 minutes into today's trading session. You are seeing a tilt into negative territory, although marginal moves everywhere but France. The French index is, of course, down by about 0.3%, underperforming its peers. The only green on the screen I'm seeing is actually in Italy, in the FTSE MIB, higher by 0.1%. But again, broadly, sentiment is lower. It's a similar story when you look over at the bond market. It looks like French yields, or French bonds, I should say, are seeing a little bit of a bid, pushing those yields lower, again, in contradiction to something you're seeing in the rest of the continent as well. A lot of that driven by what we've heard in the last 24 hours. France unveiling its budget for the next year, hitting big firms and the wealthy as it looks to trim its colossal debt pile. We are getting live images at the National Assembly at the moment. This is not the French Finance Minister, Antoine Armand, but he is sitting directly to the speaker's left at the moment. So that is something we're going to be monitoring in terms of what they're actually saying and how this all really sets the stage for some sort of comeback, some sort of fundraising for the French government. Let's get a little bit more insight on what these next steps looks like. We are joined this morning out of Paris by Benjamin Haddad, France's Minister Delegate for European Affairs, joining the opening trade this morning. Minister, a pleasure to have you on the program. Thank you so much for making time. Let's kick it off with what we've heard from the last 24 hours out of Michel Barnier and Antoine Armand as well around this French budget. There's a lot of concern from the investor community about whether or not tax hikes are the way to go if it disincentivizes staying in France. What do you say to that?
Look, this is a historic moment of responsibility for France. We're faced with a high deficit, and so the budget that the Prime Minister and the Finance Minister have put forward aims at tackling this debt and deficit over the next few years. We'll be reducing deficit by 60 billion euros, primarily by cutting spending. 2/3 of the budget will focus on cutting spending. We have right now the highest spending in the OECD, so of course this is where we have more margin, so we'll cut across the board and especially tackle structural reforms to be able to be more efficient in the future. Some of that will come through targeted, proportional, and temporary tax hikes on really a small section of the wealthiest companies and individuals. Once again, it's an issue of credibility and responsibility for us towards our partners, towards markets. In the last few years, we've been able to reduce unemployment in France. We've been able to bring back investors. And of course, that's something absolutely key for our trajectory in the next few years.
Credibility and responsibility for France. Those are some key words, of course, Mr. Do you think the folks in Brussels, your counterparts at the EU Commission, are viewing it that way?
Yes, and you know that Michel Barnier knows Brussels very well. We are, I think, awaited by our partners on this issue. In the first few years, of the Macron presidency, we had been able to bring back the deficit to 3%, the European rules. But then we've been faced with historical crisis, COVID, the Russian war of aggression on Ukraine. We've put forward spending to protect companies and households. But now it's time to tackle these deficits. Our objective is to bring back the deficit to 3% by 2029, and this is why we're doing this historical effort. Once again, I think we are awaited by our partners in Europe, and they will see today that you have, I think, France rising to this moment and taking these necessary steps.
Minister, good morning. The financial markets see Spain as a better credit than France right now. Is that fair?
Look, I mean, I don't want to go into comparisons of over countries, but what underlines your question is the necessity for us to take these steps, is the necessity to cut spending, and I think this is something that every political force in France, in this National Assembly, will be faced with. We'll be tackling the budgetary debate at the National Assembly and the Senate in the coming months. And yes, it's true that our partners, markets, our friends across Europe will be looking at France, and this is something that we understand very clearly. And this is why you have, I think, today this budget that's being unveiled that takes a important effort at reducing our deficit, at tackling public spending. And once again, it will be an effort that will be, I think, long-term structural when it comes to reducing spending.
France came up with the word entrepreneur. If you're an entrepreneur right now, do you think you want to stay? Do you think the level of taxation that you are seeing in France is conducive to those that are generating new business will want and need?
Absolutely you want to stay, because if you look at France over the last few years, it's a great place to do business. And this is what international investors have understood. France has become the most attractive country for international investors in Europe.
But Minister,
we've made it a much friendlier environment for creating. No, it hasn't.
What Emmanuel Macron has done, he lowered taxes. That was the emphasis, was lowering taxes and delivering a more business-friendly environment. That appears to have now changed, hasn't it?
Absolutely not. We've lowered taxes when you look at the profit tax of the last few years to bring it back to the average of European countries. We've also made it, when you look at rules and norms, we've made it a much friendlier environment to start a company, to start a tech company, and this is why you've seen a tech dynamism in France in the last few years. And of course, this is something that has to continue, because part of this effort will be to continue to keep investors in France, to keep companies in France, to have French and foreign entrepreneurs create companies. This is something that it will be absolutely key, because part of this effort, of course, when you look at reducing spending, tackling deficit, is also about keeping growth. Right now, France has a higher growth than some of its neighbors, and of course, that will be part of continue to bring income to the country, and to be able to tackle this deficit issue will be to continue to have growth. We're very aware of this. This is a business-friendly government.
Are you, in that context, though, Minister, good morning, are you worried about the wealthy in France deciding to leave? There might be lots of other European countries also putting up taxes, but some people's eyes might be drawn to other parts of Europe where that's not happening, or to the Middle East, to Dubai, for example.
I am worried about the impact that high debt and deficit will have over the sovereignty of our country, will have over the wealth of future generations. And I think this is something that's shared by the French across the board, including the wealthiest, including the entrepreneurs. And so this is why we're sending this message of responsibility for the future. But at the same time, once again, as I said, you've seen France become a dynamic place for growth, for tech, for entrepreneurs, for outside investors, and this is something that will continue. This is why the tax hikes that we're talking will be very targeted and proportional on some. We're talking about a few hundreds of the wealthiest companies and individuals, and they will be temporary, and that's something that's really underlined in the budget that was unveiled today.
Okay, temporary, and that's something that, the president has underscored as well. Diving into some of the individual businesses or sectors that are in focus in France right now, Minister, I wonder if I can ask you about the cognac sector. We've seen China decide to put tariffs on French cognac, and this sector feels a little, we understand from our reporting, this sector feels a little sacrificed in this trade battle between Europe and China that perhaps started with cars. Are you going to do something to support the cognac makers?
First, I want to say there's no legal backing to this decision that was made, and all the cognac producers have been very upfront and very transparent in the investigation. There's no subsidy or no illegal practice by them. The truth is that what we've seen is the Commission has launched an investigation on some of the unfair trade practices by China on electric vehicles, and has proposed putting tariffs, proportional tariffs on these electric vehicles, because once again, we want a level playing field on trade, and it's completely natural. When you look at the United States under the Biden administration, they've put 100% tariff on Chinese electric vehicles. There's no reason why Europe should be more naive or should less defend its interest than its other trade partners. So we support, like our partners in Europe, the decision by the Commission to impose tariffs. Now, when it comes to retaliation, once again, there's no legal backing to it. The Commission has announced that compensation mechanism will be put forth for producers, and that's something certainly that we will support.
So are you going to provide some support to that sector specifically?
As I said, I mean, this is something that's already been said by the European Commission, that we will put forth compensation mechanism, and I think that's only fair indeed. And once again, this is beyond just the specific sectors that are being that we're talking about. This is a broader issue of a fair level playing field at trade level. If we want, and once again, we want Europe to be open to trade, we want to be able to export, we want to have dynamic trade relations with our partners, but we shouldn't be naive. We shouldn't not defend our interests when we see others like China and the United States who do it. The United States has put 100% tariffs on Chinese electric vehicles. There's no reason why, faced with the same subsidies, faced with the same issue of unfair practices, the European Union should not be able to defend itself.
Minister, you talk a lot about the trade between Europe, France versus China. Let's talk about Europe and France versus the United States that you're talking about. There are still impending steel tariffs, steel quotas even, that have been imposed from the United States on Europe. We have a new president in the States in just under 3 months. What are you asking for in terms of those negotiations? How are they going? How are you preparing for them when it comes to the steel conversation?
You know, I regret that we've seen some of the same protectionism under this administration and under the previous administration, and that's something I think that, you know, Europeans should look at and think about. You've seen the IRA also that was decided by the United States quite unilaterally to protect its own industry, to protect some of its companies and sectors, and sometimes at the expense of trade partners and allies. And so, as I said earlier, I mean, Europeans should not hesitate also to be able to support their own industry, to invest massively in the green transition, in the technological transition, and defend their own interests. I do hope that whatever comes out of the U.S. election will keep a partner that we can have a robust dialogue with, but I also fear that we'll see a trend towards protectionism, towards isolationism. I think that would be in no one's interest, but in that case, Europeans should not hesitate to be able to defend their own interest. The key here at the European level, when you think about trade, but also other issues like geopolitical issues, is to stay united and put a united front in these negotiations.
Mr. Some strong words there in terms of competing with the United States that you say is unilaterally imposing these kind of protectionisms. Does France have the money to actively compete, to subsidize the sectors that are under threat from programs like the IRA?
You know, I was very interested in the report that was put forth recently by Mario Draghi, the former chairman of the European Central Bank. And what he underlined is the lack of competitiveness and the growing lack of competitiveness and productivity that you see in the European Union, especially when you compare it to the United States. The United States has been able to mobilize massively public, like private investment into artificial intelligence, into quantum, into a lot of innovative technologies that will be key to shaping and determining the future. This is something that Europeans should look at. We have to be able to mobilize both public and private savings to invest massively into our future. We also have to be able to lift some of the regulatory barriers that we have too much in Europe when you think about integrating capital markets. This will be absolutely critical in the coming years. We'll have a new European Commission in the next few months, basically at the start of 2025, that has to shape the agenda of the Commission.
Minister, I hear what you're saying, and I don't think there's any pushback against yours or Mario Draghi's take on that. But my question stands, does France have the money to act on the issues that, as you point out, Mario Draghi and yourself say is chief? Do you have the funding to address those issues?
But this is not only about France. I mean, we have 27 countries at the European level, and this is a challenge, I would say an existential challenge if we want to stay relevant on some of the key geopolitical, technological issues that will be shaping the future. This is a challenge that we face together, and this is why these conversations need to be held at the European level. But if I can come back, actually, on your question to the issue that we were talking about a few minutes ago, this is also why when we want to be part of the conversation, when we want to have the credibility with our partners to discuss these issues, this is why we have to tackle our deficit. This is also why, France has, I think, a key role to play, an important voice with our partners at the European level. But it's true that we are expected on the deficit issue, and this is why you have this budget of credibility and responsibility that's being put forth today. Also, not only to protect France's future and sovereignty, but also to be a robust part of the conversation at the European level.
All right. Benjamin Haddad, France's Minister Delegate for European Affairs. We appreciate your time this morning covering a slew of issues. We thank you so much. Well, it's that very conversation that, of course, is spreading around the world, I suppose exclusively with the State Department Under Secretary who covers energy, critical minerals, and the environment, about that competitive factor the minister was just talking about. Take a listen to my exclusive conversation in Madrid.
We're all facing the same headwinds. And something that I can tell you is that we are working quite closely with our European counterparts through the EU and also with individual countries. All of these countries, not just Portugal, not just Spain, they're facing some problems that are caused by overcapacity in Chinese production. So, for example, in the automobile sector, competition from China is undercutting European cars, and a lot of that is that it's state-owned enterprises that don't really have a profit and loss model. They're getting subsidies. They're not paying rent. They're not paying taxes. If they lose money, they just get more money, and they are, the companies in Europe have come to the conclusion that kind of industrial policy is not fair. And it's not helping their companies, it's not helping their workers.
Well, part of your title, of course, includes covering not just energy, but the environment as well. I'm curious what we're learning from Europe in that regard. You talk about this investment in the United States in this renewable sector, in the EVs, batteries that you're talking about. Europe was very far gone in that process, arguably more far along in that process than the United States was. You saw it in the UK, in France, in Germany as well. But it's an expensive process, not just in terms of creating those plants and creating that change in manufacturing, but creating the public infrastructure to support it. Charging stations are one example. Mm-hmm. Because of that cost, you've seen a lot of European governments, the UK, a little bit of France, certainly Germany, pull back on some of the goals and quotas and support that they provided that EV infrastructure, say, a couple of years ago. Are you worried about that happening in the States and all the progress you're referring to getting turned around in 2 short months?
I think no one assured us that this would be a linear progression. This is business. You have ups and downs. But the numbers don't lie. In many parts of the U.S., renewable energy is cheaper than fossil fuel energy. The kinds of investments that are, for example, the CHIPS Act, $52 billion. About 80% of that has already been spent. For every dollar in the CHIPS Act that we have provided for investment, the private sector has brought in $11. So it's a huge. We're providing the seed money for the new technologies. That's not stopping. I think companies, the private sector sees the progression. They see the future. It's the energies. It's the industries of the future, and they want to be part of that. So yes, we're seeing, for example, in the mining world, the price of lithium plummeting from 80,000 last time I looked a ton to about $10,000 a ton. That's a problem. That makes investment harder. It makes financing harder. But at the same time, you're seeing the demand for lithium, even though the prices are plummeting, go up by about 30% last year.
The U.S. State Department Undersecretary for Energy, Critical Minerals, and the Environment, Jose Fernandez there, joining me exclusively. Coming up on the program, we're going to look ahead. J.P. Morgan, Wells Fargo, reporting third quarter earnings ahead of the U.S. market open today. More on what the investors are watching out for next. Stick with us. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Welcome back. 8:52 in London. The market is pretty flat this morning. We are looking ahead, though, to bank earnings out of the United States later on this morning. JP Morgan will be in the headlines today alongside Wells Fargo as they kick off the US bank earnings season. Analysts will be keeping a close eye on a host of topics: trading revenues, IB fees, just two of them. Let's talk to our finance reporter, Jenny Serrain, who's with us this morning. IPO market's pretty muted. We heard that from JP Morgan's Jamie Dimon earlier on this week. That could be one of the themes around investment banking that we're looking at.
Yeah, no, I think that's exactly right. I think, a lot of this quarter is really going to be more about what the executives say on the calls rather than probably what a lot of these numbers are going to show. So obviously, yes, I think equity underwriting is still pretty much in the doldrums. We've seen a little bit of a pickup in merger activity, but probably not enough to really write home about. So I think the investment banking side of the house is still pretty quiet. The other big number that we like to look at a lot for these banks is net interest income. And with rates being as high as they have been in recent years, that's been a really standout number. But we've already started to see the central bank obviously take rates down. And so I think a lot of it will just be more around the commentary of what these executives want to kind of communicate about how they're feeling about the future of these businesses.
Is this a macro event? What am I going to learn about the US economy?
I mean, I think a lot of what you're going to hear today is, how they're feeling about how quickly the Fed might take rates down and how that might play out into their balance sheet. So far, consumers are still kind of hanging in there. So I don't think we've really seen a lot of that pressure that folks really thought folks would come under. Provisions are still expected to be really, really low. Credit's looking pristine. So it shouldn't be too much of a macro event, but there's always the chance for surprises.
So in addition to all the bank stories in the last 24 hours, or in the next 24 hours, we're also looking at the last 24 hours. TD Bank getting a $3 billion fine and some pretty severe penalties and restrictions coming out of the U.S. regulatory environment. Take a listen to what Attorney General Merrick Garland had to say.
TD Bank pled guilty to multiple felonies, including conspiring to violate the Bank Secrecy Act and commit money laundering. TD Bank has also agreed to a $1.8 billion criminal penalty. Combined with civil enforcement actions announced today by other agencies, the United States will be imposing a total of approximately $3 billion against TD Bank.
Jenny, weigh in here. This is a top 10 bank in the United States. They're really known for their acquisition strategy. How much of that announcement puts that in peril?
So they're now facing a cap on their growth, which is probably the most extreme measure that regulators can take against a bank in the U.S. And you're exactly right. They've really made their name going out and doing these really big deals lately. So I think at the very least, we won't expect to see them doing much of that anymore. I think the CEO had it right. He said this is a dark day in TD's history. Everything that was described by both the DOJ and regulators yesterday, it was pretty severe lapses for many, many years. And so this is a bank that's going to have to kind of crawl its way out of this mess for many years to come.
Jenny, thank you very much indeed. Jenny, looking ahead to these bank numbers, we're going to get a little bit later on. After we've got through that, we are going to be almost to the weekend now. Clearly, we're going to be having to watch what we get out of the Chinese Finance Ministry tomorrow. But if you're not watching that, there are other things potentially you could be watching. BFI London Film Festival kicks off this weekend. The Montmartre Grape Festival.
Yes,
which
excellent.
Sounds excellent to me.
And if you overdo it there, and if you overdo it at the Berlin Food Week, I also noticed there is a marathon in Budapest. So you can, get to Budapest by the end of the weekend.
So you drink, you eat.
Watch a film.
Watch a film from London to Paris to Berlin, which you can do because it's Europe. And then you run a marathon and be ready for Monday.
Yes, and if you like the NFL, you can get back in time for that. And if you don't, you can stay away until it's finished.
Yes, a game which apparently you don't play with your feet. That's called football. Anyway, that is it for the opening trade. The Pulse is up next. Have a great weekend, everybody. We'll see you Monday. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Traders pair bets for a Fed cut and watch out for more stimulus out of China this weekend. Tesla unveils its long-awaited Cybercab. Now, production of the robo-taxi is expected in 2026 and may cost less than $30,000. And France aims for big businesses and the wealthy in an effort to tackle its debt pile. Details of the budget plan ahead. But first thing is first, let's take a look at the European markets map. Now, if you look at markets, they've had quite a week. I have to say, happy Friday, everyone. We've made it through the last day of the working week because there's been quite a lot going on. Now, for the moment, European stocks, but also U.S. futures are practically unchanged. Again, a lot of the traders are still trying to digest this hotter than anticipated inflation data in the U.S. And then they're also getting ready for U.S. earnings season. It kicks off today, and then it really gets going into the next week. So let's look cross-asset. I'd look at yields. I'd also look at euro dollar and a couple of the other things. For example, Brent crude. We had Jeff Curry earlier on this week really talking about some of the complex things that has to do with oil. Brent 78.59. You see the U.S. 10-year yield at 40747. Now, Elon Musk has unveiled long-awaited prototypes of a Tesla robo-taxi called Cybercab. He says production may start in 2026 and that the vehicle could cost less than $30,000. You can see Tesla actually down some 4.5% pre-market. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning and welcome to The Pulse. I'm Francine Lacqua here in London. Now, joining us to talk about the markets, Monica Defend, head of Amundi Investment Institute. Thank you, Monica, for getting us started on this Friday morning. There's been so much going on. Not only Fed price expectations, but actually the ECB has changed quite a lot of what it wants. What did you learn from the inflation numbers in the U.S.?
Well, we think that in any case, the disinflation trend is in place. If we look at the components, actually, those that were on the rise are those prone to volatility. So we hold with these 50 basis points cuts, 25 each time from now towards the end of the year.
So what does it look like in terms of treasuries? Where do you want to put your money in, Monica?
On the fixed income spectrum, it's really a matter of being tactical. So honestly, duration-wise on the US, we are plugged into a neutral position, but we do like steepeners, in particular on the 530 part of the curve. But we really manage it quite tactically.
Monica, when you look at some of the things that we heard, of course, from, for example, Mr. Goolsbee of the Fed, I mean, he, was praising some of the progress on inflation in the labor market. First of all, let's listen to what he had to say.
All of the measures broadly have been showing a labor market that is cooling from a white-hot level to something like sustainable full employment. I haven't seen anything that is yet convincing that there's a new trend that we're not stabilizing at full employment.
How much do you worry about employment, Monica?
Well, we think that this is a target of the Fed to cool the labor market, and it is actually stabilizing. We do not expect a crack, and as a whole, we do believe the U.S. economy will slow down. A recession is definitely not our base case. We are more on the soft landing scenario. But there is another important piece of information, the reporting season, so the real economy, the earnings. We will closely monitor how the corporate sector will report.
Monica, do you worry that inflation actually picks up in the next 8 to 9 months?
Yeah, we've been discussing this while penciling the outlook for 2025, and it's a risk scenario, and probably the risk on top of our wall of worries. But as I was saying, the base scenario is the one of the Fed seeing inflation at target towards mid-2025. But indeed, it is a risk.
I mean, when you look at the fiscal policies, and I know you write about this very extensively, Monica, I mean, it's very different if you're sitting in France, Germany, the UK, or if you're sitting in China. What does that mean for investment opportunities?
For investment opportunities, it means that the outlook is quite heterogeneous, so there is plenty of opportunities on the fixed income market, for example, on the UK, on the euro curve. And on China, we keep our eyes open over the weekend to see what the Ministry of Finance will release. And this, depending on the size and the speed of the package, can be a game changer. For the time being, we maintain a neutral positive bias on the Chinese risk assets. But definitely, it's a time where we are quite active because the calendar is full of events.
It certainly is full of events, Monica. I feel like we're just always trying to catch up with the number of data or the number of news stories that we want to bring all of our viewers. Again, what's your take on euro? If you look at some of the opportunities in fixed income or also in the FX space, what do you have top of your list?
Well, we do believe that the euro will progressively appreciate. So we are starting to build on some longish euro position versus the US dollar. On the equity side, we do like the small cap asset class, for example, across the European corporate sector and some of the UK names. Overall, though, we maintain a light risk exposure. On the fixed income, we do like investment grade, definitely. The euro investment grade is something we like, and the euro duration. On peripherals, we maintain a constructive view for the time being.
Okay, Monica, keep it there because we also want to talk a little bit about Elon Musk. In a Hollywood-style production, Tesla CEO Elon Musk has unveiled a robo-taxi without a steering wheel and pedals at an event in California.
We expect to be in production with the Cybercab, which is really highly optimized for autonomous transport in probably, well, I tend to be a little optimistic with timeframes, but in 2026.
Well, pre-market, actually, the stock is a little bit under pressure, down some 5%. The event did not address how Tesla will make the leap from selling advanced driver assistant features to fully autonomous vehicles. Let's bring in Craig Trudell, Bloomberg's global autos editor. Craig, I mean, this is my dream. I mean, I would love to be driven around in one of these, but why is the share price down so much?
Yeah, same for my wife, I should say. She wants to retire from driving. But I think what the market is pricing in here is we saw a huge run-up in this stock in the months leading up to this event. And what everyone was hoping to hear from Musk was a little bit more substance in terms of, whether we can really hang our hat on the idea that production will start. Some people wanted to see, for instance, the next generation Roadster that Tesla showed way back in 2017. That still isn't in production. So when he says, it'll be in production in a couple years, if you've been following him closely over the last half decade or so, you should know that to take that with a big grain of salt.
So why does that? And he was funny. He said, I tend to be a little bit too optimistic. But is it the technology, or is it that he's distracted and so can't produce them?
I mean, I think there are real questions about both, right? I mean, he after all has been out on the campaign trail as opposed to necessarily diving into the nitty-gritty details of the robo-taxi, at least. That's been the sense, and you see him sort of ramping up his activity on X over the last months, even to a degree that is unusual even for him. And I do think that, technically speaking, we've seen so many automakers over the last, call it 10 years, have high hopes for being able to offer autonomy, but everyone except him has really sort of come to this realization that this is really, really challenging to make this road ready and safe for people to use.
Craig, thank you so much. Craig Trudell there, Bloomberg's global autos editor. Let's go back to Monica Defend from Amundi. Monica, I mean, when you look at some of the industries, and we are expecting quite a lot of earnings in the next couple of months, where does tech sit, for example, compared to cars, compared to financials?
Well, in terms of valuation, still, it's in particular, some names are incredibly expensive. So what we do expect, and also to reposition more boldly on the equity market, is for this valuation gap across the various names to broaden and to close. Therefore, on the tech, we are on the sector as a whole, we are neutral. So it is not where we do like to position the most, with the exception of some names. If I look into the sector positioning, really, I would say that we do prefer financial over consumer staples. But again, it's a market that doesn't allow you really to be strongly directional and to be risk on. We do prefer to have in place relative bets with hedges, so that we can move along this uncertainty that will stay for a while until, for example, the U.S. election. Then something might change.
Monica, when you look at, for example, some of the financials, I know you like financials. I mean, if you're a non-U.S. financial, if you're a European financial, can you really compete?
Well, actually, if I look at the sector allocation, this preference for financial is broadly spread. It's in Europe as well as in the US. But as I said, if you play it in a relative way within the region, it makes sense.
Monica, thank you, as always, for joining us. Monica Defender from the Amundi Investment Institute. Now, coming up, with polls suggesting a close race, very close race, we'll explore just what's at stake ahead of the upcoming U.S. election with Libby Cantrell, head of U.S. public policy at PIMCO. That's next, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back, everyone. Now, we all know it. In less than 4 weeks, Americans will vote in one of the most consequential elections in U.S. history. Now, polls put Kamala Harris and Donald Trump neck and neck, and the chance of either the Democrats or Republicans sweeping the presidency and both houses of Congress is considered low. Now, let's discuss all of this with Libby Cantrell, head of U.S. public policy at PIMCO. Libby, I'm so happy you're in London. I mean, we're literally obsessed with what's going on, and the fact that the race is just so close.
It is so close, and it honestly. Since obviously Harris coming on the top of the ticket when she had a nice boost in polling, effectively since then it has been stagnant. The race has effectively not moved over the last 6 weeks, and this will come down to the marginal issue, to the marginal vote, and so any marginal event that happens over the next 25 days, 24 days, who's counting, will likely matter at least at the margin. But I think you're right to talk about Congress because from an investor's perspective, honestly, the composition of Congress matters just as much. So as what the White House, the run for the White House has sort of captured the imagination, both here and in the U.S. We are trying to focus our clients on the composition of Congress, so that will matter just as much.
But Libby, why has Kamala Harris not been able to capitalize? I mean, she had a good debate, right? And we saw an uptick in polls, and then it hasn't really gone anywhere. So is it strategy? Is it policy? Like, what are people not sure about?
Yeah, Francine, the really interesting thing about Kamala Harris and her poll numbers, particularly her approval numbers, is that she really has gone, not to be glib here, but she's gone kind of from zero to hero. Her approval ratings have increased by about 12 points. That may not seem like a lot, but that does not happen in U.S. politics. Honestly, the last time that happened in modern U.S. history was post 9/11 with George W. Bush when he saw that bump up in approval rating. So people really like her. I mean, this is the interesting thing. People really like her, and on temperament, on personality, on character, she does pull much higher than Donald Trump. But this is what we're telling our clients, if this election does come down to sort of personality and vibes, Harris has a good chance of winning. But if this is about policy and a path for economic policy, for sort of the trajectory of the United States, a lot of folks are saying that then they would want Donald Trump. They may not like him, but they like his policies.
What policies? Let's actually hear it. So he was talking, I think, yesterday about tariffs. Let's listen to what he said on that.
I will impose whatever tariffs are required, 100%, 200%, 1,000%. They're not going to sell any cars into the United States with those plants.
I mean, it's difficult to know. I mean, probably not 1,000, but actually, does it make sense?
Yeah, so I do think investors should take this rhetoric relatively seriously. Again, maybe not 200%, not 1,000%. But what we know about President Trump is, one, he believes in tariffs. He's been talking about tariffs since the 1980s. He opposed tariffs on China. Of course, not to the extent that he said he was going to, but he did follow through with that. He can do much of this unilaterally. And I think something, Francis, that's really important between a potential Trump 2.0 and a Trump 1.0 is he was singularly focused effectively on China and on the trade deficit with China and getting a deal with China. I think you fast forward to a Trump 2.0, the aperture is going to be much wider. It's going to be on things like Mexican cars or German cars or Japan or Ireland, other countries where the trade deficit has actually increased. And so the aperture will be much wider. So I do think we need to take him seriously on this. You know, we're saying to guide into our clients, you may not see 1,000% tariffs, but you will see tariffs. The direction of travel here is very clear. Tariffs are going to be increasing not only just on China, but on other countries as well.
What does that mean for inflation? What does that mean actually with the composition of the economy?
Yeah, so the market, is really focused on the potential inflationary impacts of tariffs, and that's for good reason. But also, the thing about tariffs is it cuts both ways. It can also be a headwind to U.S. growth in terms of demand destruction on the consumer side, but also impacting the export economy, export sectors in the U.S. as well. So, again, hard to tell and hard to feign precision here, because so much of this will depend on who he puts in his cabinet, what he actually follows through with. But again, the direction of travel here is clear. Inflation will likely be going up, and also growth could be hurt if he does what he says he's going to do.
Will it only be loyalists in the cabinet? Because that also changes policy, right? If it's him doing every single decision.
Yeah, so I think what we saw under Trump 1.0 is he was able to attract actually a widespread, very credentialed group of folks. I think that just, based on the mood music, I think a lot of those people actually may take a second look and maybe reconsider going into a Trump administration. Folks that he's talking about for these big, Treasury or Secretary NEC director, they're folks that the market is familiar with, and I actually think that would probably be well received by the market.
Okay, Libby, thanks so much. Libby Cantwell from PIMCO stays with us, and we'll talk a lot more about the Democratic side and what Kamala Harris can do in the next 24, 25 days. Who's counting? This is Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With the surge you have crypto, stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back, everyone. Still with us, Libby Cantrell, head of U.S. Public Policy at PIMCO. Libby, we were talking. Thank you so much for sticking around. We were talking a little bit about why people have a good scorecard, I guess, for the economy under Trump. Is there anything? What does Kamala Harris do now to try and get votes from now until November 5th?
Yeah. So again, I mean, the electorate really is calcified, right? So it's, you're not going to move 48% of these sort of, always Trump voters, or at least, pretty clear Trump voters. So it's really just a question about, we were talking about a few 100,000 voters, maybe even fewer. And again, in these sort of 7 swing states, because of course we don't vote, the national vote, the popular vote doesn't really matter. And so there is a risk actually that with Kamala Harris, like we saw with Hillary Clinton, where she actually wins the popular vote but loses the Electoral College. So you're going to see her in these 7 swing states. You're saying many people over here maybe are not familiar with them: Wisconsin, Michigan, North Carolina, Pennsylvania. Pennsylvania is the most important state. So honestly, how goes Pennsylvania, so goes the White House. So we're likely to see both candidates be spending a lot of time. But she's, I think she needs to win. She's already winning on personality, as we discussed. She needs to start trying to win on policy and reassure folks that some of those policies that she had staked out when she was running for president back in 2020, very, very progressive, pretty much out of sync with definitely the majority of the country, that those were not, that she sort of disavowed those and that she sort of moved on.
But Libby, the economy's doing great.
The economy is doing great, yes.
So why is that not translating?
Yeah, and this is the thing. I mean, I think also there's, inflation has been such a headwind for voters. There's this axiom in U.S. politics: the price of a gallon of gas, the price of a gallon of milk. These things have gone up a lot since Biden was inaugurated, and this is why folks give Biden low marks, the president low marks, but they also sort of implicitly have given her low marks as well. They're also nostalgic for the 2019 economy, kind of pre-COVID, high real wages, high labor force participation, stable, not wars. And I think that's the other thing, is that this sort of foreign policy doesn't usually rank up very high with U.S. voters. We have the sort of luxury of being very inward focused, maybe to too much of an extent. But now it is, right, when you're actually diverting resources that could otherwise be going to Americans overseas. It actually is registering, and I do think that they are quite different on their foreign policy views.
Olivia, how does Congress go?
Yeah, Congress, again, so very, really important. Your taxes and spending all go through the legislature. And then really importantly, Francine, I'm not sure people sort of understand this nuance, say if Trump were elected, anybody who he nominates to the Fed, for instance, or for Treasury Secretary, has to be confirmed by the U.S. Senate. So the composition of both the Senate and the House really matter. Honestly, a very tight race there. I mean, really what we're looking at is a very kind of, again, calcified, narrowly divided electorate, and that will be represented both at the White House but also in Congress. I think the Senate probably flips from very narrow Democratic control to very narrow Republican control. And we may actually see the House flip as well from very narrow Republican control to narrowly divided Democratic control. It'd actually be the first time in the history of the Republic where both chambers flip to the opposite, opposite parties. But I think that for investors, the big implication here, narrowly divided Congress, likely not going to actually see very much get done, kind of pointing more to gridlock than to big partisan legislation.
And we haven't even talked about deficits. You'll have to come back.
I would love to come back.
No one's talking about the deficit, actually.
Deficit, yes. 6.5% of GDP. Who cares? Yeah, exactly. Apparently. Not to politicians in Washington yet.
Yeah, until an auction goes badly.
Exactly.
Libby, thank you so much.
Thanks so
Libby
much.
Cantrell from PIMCO. We'll hear, I hope, much more before the election from Libby. Coming up, as the French government unveils plans for tax hikes and spending cuts in next year's budget, we'll speak to Marie-Pierre de Bayancourt, Managing Director of the Institut Montaigne. That's next, and this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. Traders pair bets for a Fed cut and watch out for more stimulus out of China this weekend. Tesla shares slump pre-market after unveiling its long-awaited Cybercab. Production of the robo-taxi is expected in 2026 and may cost less than $30,000. And France aims for big businesses and the wealthy in an effort to tackle its debt pile. Details of the budget plan ahead. Now, France has unveiled its budget for the next year, hitting big firms and the wealthy as it looks to trim its colossal debt pile. While the country aiming to deliver 60.6 billion euros worth of tax hikes and spending cuts. So for more on this, we're joined by Marie-Pierre de Baillancourt, the managing director of Institut Montaigne. Thank you so much, Madame de Baillancourt, for joining us. First of all, when you look at the budget, how will the Assembly, but also the people of France, take it?
Well, good morning. Thank you for having me. Well, the people of France are still waiting to understand how this budget is going to concretely unfold. The government and our Prime Minister, Mr. Barnier, in his general speech to the Parliament, announced 5 priorities, 1 method and 1 requirement. The requirement is, of course, as you said, the unpiling of the debt, which is extremely critical because it matches 3.2 trillion euros, and it's the deficit of our GDP is 6%, while it is 3.5% in the Eurozone. So it is critical. The method is about having a consensus, and the 5 priorities encompass the whole array of French concerns from the far right to the far left, standard of living and income, security, immigration, better public services, and last but not least, fraternity. So everyone got what they demanded.
Yeah, how do you think the proposal will actually be modified in the debate in the National Assembly? Again, Mr. Barnier has a very fragile government that could be toppled quite soon if it doesn't go ahead.
Yes, true. I have no crystal ball, so I don't know how each parliamentary member will vote in his own conscience. What I can say is that the margin for action is extremely narrow, and Mr. Barnier, in his budget, chose to address a part of the population we will not got down in the street. I mean, you have on the 60 billion requirement budget of savings, you have 40 billions from expenditure from the state and 20 billion ask of companies and high income. We don't know how people will react, but one thing for certain, those people, they don't go and protest in the street.
Yeah, and this is one of the questions that we're trying to understand, really, Marie-Pierre, is that there was a government report, I think, that came out and saying that, you know, Emmanuel Macron did many, many measures put in place to attract the wealthy, to attract the rich, to attract the bankers post-Brexit, and that could have cost them 4.5 billion euros in tax revenues, but at the same time, it increased GDP. So do you see a lot of wealthy leaving France on the backs of higher taxes?
Once again, I don't know, and there have been precedents. I think the government is trying to appeal to everybody, citizen concern. They try to appeal to companies, saying this is a specific effort in very dire times, and trying to put the burden on a little bit of everybody. My concern is that while doing so, they alienate a lot of people for a small gain. With the retirement, the pension reform, it was the same thing. At the end of the day, there was everybody in the street for a savings of 8 billion from now until 2027. So my concern is about, is it enough? Is it ambitious enough? It is clear enough? Or is it a lot of efforts for a small gain? To be more precise, for example, the reform of the state is slightly addressed, and I think this is one of the main issues. You have two main areas of savings that are required: structural reform on the state and structural reform on social benefits. And this is not much addressed. On the other hand, I understand his margin for maneuver are very, very slim, so he's trying to find a path in this very difficult environment.
Marie-Pierre de Vaillancourt, thank you so much for joining us today. Of course, we'll follow this very, very closely. She is Managing Director of Institut Montaigne. Now, here in the UK, this weekend marks the first 100 days of Keir Starmer's Labour government. Caroline Hepker from Bloomberg Radio is here with the Prime Minister's report card so far. So, Caroline, thank you so much. You've been, doing quite a lot of reporting in the last couple of weeks to try and bring us what we'll hear in a second. So, what's the verdict in the first 100 days?
Yeah, I've been speaking to a smattering of top financiers, of business leaders over the last 3 weeks. I think essentially the verdict on the first 100 days of the Labour government is a bit unimpressed and wondering where the extra details are. So, for example, I was speaking to Michael Moore, who's the top lobbyist for private equity and venture capital, BVCA, the industry group here in the UK. He's saying, yes, OK, they've ticked some boxes in the early days, but more detail is required. He talks about them having a small C conservative approach, which is quite weird given that it's a left-wing government. Mike Eakins, who's CIO at the Phoenix Group, saying that companies like him, who provide a huge swathe of retirement options for people in the UK, they want a pipeline of investable assets for businesses like theirs, and they are standing ready, in his words, to invest more, but they want more details. Anne Glover, who is the co-founder of Amadeus Capital Partners, she was saying that there has been no big win for the Labour government in these first few weeks in office. She says, admittedly, stability does take longer. It implies something more long-term. But she did have this warning ahead of the budget on the 30th of October.
Well, it goes to the tax questions. It's really, if they're going to be changes, phase them in. Don't do them all suddenly. There is a tendency for governments to kind of want to announce the change the next day so nobody can game it. I think that would be a mistake. Don't be ideological about it. Be practical and listen to the consultations that they have been engaging with.
So that was Anne Glover. Of course, she's been an investor in the UK for 30 years.
So there's also this big investment summit on Monday. Question marks about the timing because it's 2 weeks before, of course, the budget on October 30th. But what can we expect on Monday?
Well, this is the issue. For example, if you look at the main business lobby group here in the UK, the British Chambers of Commerce that I also spoke to, they want the government to be bold. They want more of a roadmap as to what is going to happen. And you're right, largely across those business people that I spoke to, there was a feeling that actually the Investment Summit has been mistimed. It has been a successful event in the past. Under the last Conservative governments it was. We know that there is now an investment minister in place. That was something that the Labour government struggled to fill, but it's only days ahead of that. We know that some major international investors are going to be here, but probably not the big Wall Street titans. And so it's an opportunity to lay out what Britain can offer these investors. And yet again, people want more detail.
So what about the budget on October 30th? There were like big plans which now could be watered down.
Yeah, exactly. Everybody wants to understand what are the tax implications. Lloyd Lee from U Capital investing billions into regeneration projects here in London, for example. One of the few businesses that said, yes, we are investing more in the UK as a direct result of this new Labour government, worried about what the tax implications are going to be, both for employees and for employers. Across the board, people are worried about what the tax increases are going to be. Going back to kind of private equity, it's not widely understood if you're not in finance, the importance of private equity in the UK, and the BVCA are worried about whether they're going to be changes to the carried interest tax regime. So again, Michael Moore was saying, we understand the message from the Labour government that you have to have skin in the game, is what he said, in order for some version of the carried interest tax regime to continue in its current form, but we still just don't know what the tax policies are going to be of this Labour government. And that, again, is quite different to what we've had in previous administrations, where there have been just loads of leaks and briefings ahead of the budget. Maybe there's still time, though. There's still a few days to go.
There is. Caroline, thanks so much. Caroline Hebker there on the very latest from the UK. Coming up, it's banking earnings season, and in a few hours, we'll find out how a number of Wall Street heavyweights have performed. We'll give you a preview next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The conversations that matter and the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, JP Morgan will be in the headlines today alongside Wells Fargo as they kick off the U.S. bank earnings season. Analysts, of course, will be keeping a close eye, very close eye, on trading revenues and IB fees. Well, let's get more with our finance team leader, Jenny Serain. Jenny, I mean, I'm quite excited about earnings season in the U.S. I know your team doesn't get any sleep because it's like coming thick and fast. But it sounds, of course, like IPO markets are still pretty muted. So what are we going to hear from the banks?
Yeah, I mean, I think that will be one of the big things is on the investment banking side. You know, we saw a little bit of a pickup in merger activity so far this year, but probably still not enough to really write home about. And so, you know, we're now 3/4 of the way through the year. How are people feeling about things like bonuses? If this picture really doesn't turn around anytime soon, you know, do the banks start having to think about tougher decisions on their investment banks? And yeah, I think that will be one of the big question marks that analysts really have. You know, you've got 3 months to turn this around. Does that really seem like a possibility?
Where are the bright spots?
So I think a lot of it, honestly, will be in more of the analysts or executive commentary and the analyst calls. So like net interest income has been one of the big bright spots for these banks, and I think it'll still hang in there, but that's expected to come down and come under pressure as the Fed cuts interest rates in the coming quarters. So I think a lot of it will be about how these banks are planning to kind of navigate this new environment that they're entering into. We'll probably hear a lot about cost cutting, and so expenses could end up being something that people really pay attention to. I think it'll be a bit of a mixed bag.
Jenny, I mean, we're so close to the U.S. election. Does the outcome matter to the banks?
I think absolutely. And so I think that'll probably be the number one question we hear from analysts on this call. We'll probably hear a lot about these banks stress testing their businesses for both outcomes. We might even hear a little bit about what they're doing for actual election day. You know, that's a really big trading day. And so how are they getting ready? Are they making sure that their systems are up and in place? So I think that will be one of the big key features of the calls today.
Jenny, thank you so much, as always, for the terrific roundup. Jenny Serain there, our finance team leader here in London. Coming up, our interview with James Voles, team principal of Williams Racing, and how it's betting on rule changes in Formula One to boost its performance. It was a good conversation. It's coming up next, and this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control?
How does the current fighting completely stop?
I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg. Well, Stellantis has announced the departure of its CFO as it seeks to regain investor trust and stabilize the business. Well, Natalie Knight only joined the carmaker last year but faced backlash over last month's profit warning. Let's bring in Bloomberg's Oliver Crook in Berlin. Ollie, hi. Knight's departure is part of a broad management shakeup at Stellantis. What do we know?
Yeah, Francine, listen, after that profit warning, as you mentioned about 2 weeks ago, something had to be done. And what was done after a 2-day board meeting in the United States by Carlos Tavares, the CEO of Stellantis, was a massive shakeup across the entire business globally. So we had the departure of the CFO. As you mentioned, we also have a shakeup at the COO's office, both also the local COOs, both in North America and in China, as well as the heads of Maserati and Alfa Romeo. And this comes as Carlos Tavares is dealing with a lot of things, including obviously the sort of broader sentiment within the auto industry, but a few idiosyncratic issues. They have a lot of inventory stuck in the United States. They've got issues with the unions. And of course, Francine, he's flying from the U.S. back to Rome to go to speak before lawmakers because they are very concerned about the fact that they might have to close factory and there's not that kind of capacity being generated within Europe. We also think about Carlos Tavares as this is basically his last year and a half as CEO. We know that John Elkann, the chairman, is looking for his replacement. The question will be for Tavares, will he be able over that period of time to both weather the storm and also bring exciting new cars to market? And that's exactly what we'll ask him when we speak to him on Monday from the Paris Auto Show. We should say, Francine, that this morning, after all of those moves, the shares are down 3%. That brings the shares down about 20% since that profit warning. So investors may be not taking solace in this management shakeup.
So we got delivery numbers also from Mercedes and BMW. What story does that tell us?
Yeah, so listen, not a very good story either. We had also profit warnings, not just from Stellantis, but from Mercedes, BMW, and also Volkswagen. And we got some of their delivery figures that tell us a very sort of negative story, particularly, Francine, in China. When you drill down into the China figures for these car makers, you had Mercedes down 13%, you had Porsche down 19%, BMW down 30%. If you think about that, Francine, that is 30% decrease in BMW's biggest market in China. And that is even before any conversation about retaliatory tariffs. There is one silver lining, Francine. I did look for one for BMW. They did manage to increase their EV sales by 10% in the quarter. That really bucks the trend for a lot of the automakers that are really struggling with those EV sales. And you show it there, you can contrast it to Mercedes, which was down 30% in the quarter. So overall, more bad news for the auto sector, Francine.
Ollie, thanks so much. Oliver Crook there in Berlin. Now, on Monday, we're live from the Paris Motor Show, where we'll also be speaking with the chief executive of Stellantis and a host of other leading figures from Europe's auto industry. Now, the Williams Formula One racing team is putting off plans that would benefit performance on the track. Instead, they have chosen to invest money in the 2026 season when new regulations are put into effect. Well, I spoke to the team principal of Williams Racing, James Vowles.
There's a real balance in our sport of trying to be successful now, because we have a race every 2 weeks, so you know whether you're doing good or bad, and you're accountable every few weeks for that. But we have to be investing in the future fundamentally, so that's both in 2025, which is a carryover of these regulations, but also into 2026, where I think it's the largest regulation change that I've known since I've been in the sport.
So what does that mean for your team?
What it means is there can't be a focus on now. There has to be a focus on the future, an absolute focus on the future. And that won't be the same up and down the grid. If you had other individuals here, they'd be more telling you next year is our championship year. For Williams, that's not the case. For Williams, we need this large regulation change in order to make sure that we're investing in that future at the cost of 2024 and 2025. And as long as your board are on board with that and your sponsors are on board with that, and they all are, and they understand that we want to make not small steps, but jumps. Yeah. We've got to do this the right way, which means that we've got to sacrifice the now for the future. And as a result of that, I'm confident it's the right move for us. And it's an opportunity.
But so concretely, how differently does the grid look like in 2026?
I mean, the good news is you'd have to watch the TV in 26 to find out. But I think you'll see big shifts. Over the last 3 years, we've pretty much, even this year and last year and next year, you're pretty much no teams are going to move dramatically. There was McLaren that's done a really good job moving forward. We've moved forward through the grid, but we're all getting closer, and that's the fact of these regulations. 26, you almost throw a dice to it. You start again. You end up with a shaking up the order. Great for the sport, great for the viewership, great for us, I hope.
So what does it take to get you up higher in the grid?
The main thing is this, that there's a finite amount of resource. All businesses have near enough finite amount of resource. We do as well. We're constrained by a cost cap, which is a brilliant item, by the way. But what that means is we simply can't just put more money into the bag to focus on the future. That's how we used to do it 5-10 years ago. What we have to do is you've got to pull a resource, up to you how you divide it up. And what I've chosen to do is divide near enough all of it into 26. We're just going to get a car out there, we're going to do a great job in 24 and 25, but it won't be the jumps that we make. What it means, though, I'll give you an example. The team's around about 1,000 people. Aerodynamic teams are about 150 these days for everything, but you can then divide that up and say, I want 10% working on just 24 and 25. That's it. Right. 90% of those are looking at the future.
But again, how exactly does the money get spent? Like if you look at your 1, 2, 3 priorities.
So financially, what makes the car quick, first and foremost, is aerodynamics and the integration with vehicle dynamics. So we will make sure that we're investing in simulation technologies, investing in how we design the car, how we build the car and the aerodynamics around it. Because it's not just the bits that you see really on the surface of the car. What makes aerodynamics work is the whole package working together at the same time. So that's where you put your money. But there's not a lot you can do, surprisingly, in 24, apart from think about where you want to put your money in 26. Go through some concepts in your mind. There's a regulation that we've all agreed to where we can't actually put this car in what's called the wind tunnel. Effectively, it's where we develop the car primarily until January the 2nd, 2025. But what we can do is think about what we want to be testing all the way through the months of January, February, March, April, and get those all prepared now so that we're hitting the ground running.
We're seeing more money coming into the sport, I guess, as an investment. Are there unintended consequences of people seeing it as a financial investment instead of a sport?
I don't know if that's unintended consequences, but I'll give you my background into this. For many years, for about 30 years, I've been in the sport, and I consider it a sport. It's an arena where you want to win. No, you want to dominate, not just win. That's what I want to be doing within this environment, and I've had the pleasure of doing so within a different team. But we were never profitable. We were never even a sustainable business. For 4 or 5 times in my career, I can remember moments where I thought I didn't have a job from one day to the next. That's not sustainable long term, and that's different to where we are today. Where we are today is we are a business and a sport. And what I mean by that is the cost cap keeps us sustainable. We can't spend more than that anymore. Particularly, we can do within the arena of marketing and commercial, but on the car we can't. And that's all of a sudden changed the dynamic into something that's sustainable. And the finances coming in are now creating an environment where teams can be sustainable for 5-10 years, not worrying about what's happening next year.
Well, that was team principal of Williams Racing, James Voles, and you can, of course, continue listening to the interview. We've also put the whole 15 minutes online. Now, Tesla shares have slumped pre-market, trading as Elon Musk unveiled prototypes of the automaker's long-awaited robotaxi Cybercab. Now, Musk says production may start in 2026 and that the vehicle could actually cost less than $30,000. Analysts note that the event did give a clearer picture of the company's autonomous plans, but it was light on details. A couple of things we're watching out for. Look, there's been a lot of data, of course, from Monday, I would say, until yesterday. European stocks, but also U.S. futures, little changed. Traders still digesting some of the hotter than anticipated inflation over in the U.S. They're also ready for the earnings season to take off. It was yesterday that we got this higher than expected inflation print for the month of September, but also rising unemployment benefits seem to underscore the challenge that the Federal Reserve is facing, which basically seems to be indicating some stalling progress in the fight to bring prices to target. Now, investors will also be watching U.S. September producer price numbers today for further indications about the Fed's easing path. When you look at, for example, what yields are doing, I think we have the 10-year yield up for you, 4.0767. Up next, a Bloomberg Brief. Danny Berger's in New York, and this is Bloomberg.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Danny Berger, Manish Cranny on a well-deserved break. Welcome to Bloomberg Brief. Let's set your agenda. Autonomous dreams. Musk unveils Tesla's new robo-taxi, estimating that production may start in 2026. The data puzzle, jobless claims at a one-year high and hotter than expected CPI. The Fed's next move remains in question. And earnings season begins. The big banks report their numbers, with JP Morgan and Wells Fargo kicking off before the bell. Well, it's a confused market, driven by confused data. We're in a period heavily influenced by storms and strikes. Hard to get a clean read. For this equity market, it is weaker this morning after a weaker session yesterday. We are off the highs. The next thing we do is we await reports from JP Morgan, Wells, and BNY Mellon, all before the bell today. Russell 2000 leads the declines for bonds. Still below 4%. The front end pushed below there yesterday. Yields up about 1 basis point across the curve, a little bit more than that. More concerned perhaps yesterday on higher claims data, but CPI did push up inflation swaps. Oil also weaker. You can see that on the bottom of your screen after a rally yesterday. Last night, Israel's Security Council met. It was up yesterday over concerns of what retaliation might look like. Well, Ella Hoja, head of fixed income at Newton Investment Management, looking ahead, writing, "We have reduced risk substantially at the end of September and shifted from long to short treasuries." Ella, I'm pleased to say, joins us now. Ella, I want to work through this call. Let's start with risk. Why the reduction?
I mean, the symmetry is something that appeals to us, typically speaking, and that was the case around April or May. But here it's sort of, we would say, probably at best fair value for the front end of the curve in the US, and it's heavily positioned for. So we have the steepener trade, which is probably one of the most favored trades in macro community. And so that makes it tricky to have high conviction. So that's predominantly the reason. So we're a bit more fairly priced in rates markets now. And in terms of credit markets, they're also priced for good outcomes, broadly speaking. So it's difficult to push in any direction. So it makes sense here to have lower levels of risk, particularly given that we have quite a bit of event risk ahead of us over the next several weeks.
Yeah, that is like maybe even an understatement, Ella, just how crazy the next few weeks are going to shape up to be. How much of that of reducing on the front end is also about the Fed and their ability to continue to deliver cuts at a sizable pace and scale?
Well, I mean, visibility is low here, both for the Fed and I would say for macro community. We definitely have empathy for a softening labor market. So this is how we've been leaning with rates for the second part of the year so far. But at the moment, it's not very clear, and it might take some time to clarify. And we have to get through this particular events. And the Fed's going through the same thing. And of course, we saw yesterday headline inflation tick up, whilst core still remains, a little above comfort level. So it's a tricky one for the Fed. And that's why you say at 4% rates, it's neither here nor there. So what do you do with that? I think you need additional information. You need to know what the outcome of the election is going to be, and particularly a bit more clarity on the jobs front. Those are the two most important vectors.
Well, Bostic even saying yesterday that the data basically backed up your idea, Ella, that choppiness is maybe a reason to be patient. But you say that there's a change in this market, that it now pays to be reactive. How do you be reactive, though, when the data itself is confusing and the immediate market reaction isn't necessarily one that you can predict?
Well, I mean, I would have to say that particularly as an investor, my edge tends to be contrarian, so I'm not a good follower, and so I will put that out there. So to be reactive, at least you need to understand the landscape in front of you, and back to sort of where is the asymmetry. And if we talk asymmetry, certainly a Republican sweep would offer an asymmetry, as in you can see rates markets priced a little bit higher on that vector, and perhaps equity markets might like that outcome. So, those are probably the scenarios where you can have a bit more clarity. Otherwise, on sort of the highest possible scenarios, as per the betting market, seem to be that we're going to have a divided house, and therefore that might mean actually more of the same, i.e. focus on the cyclical picture and focus on the jobs data. So I think that's how we're going to know, right? So that's why we need this event to be out of the way in order to focus for the next leg in the macro space.
I know we want to focus on what's after that, but Ella, I just want to take us to that week itself, where we have an election. We might not know the outcome in the immediate aftermath. It might take days. And we have a Fed decision, too. Just what do you do that week? What are you telling, basically, clients, investors? Is it a stay on the sidelines? Is it be reactive? Is it get ready with hedges and just cross your fingers and hope for the best?
Well, hopefully our clients pay us to do better than that, right? Cross our fingers. But I mean, look, I think there's ways in bond markets where you can actually obtain a significant yield over and above through, careful portfolio construction. And so that's what we're doing. So earn a bit of additional yield, a bit of additional carry, but actually balance the portfolio better. So I think that's probably the best way to approach this event risk. And that's why I say it is one of the cases, particularly the first time this year, where it pays to react rather than sort of proactively position your fund. And so with that in mind, we're ready to sort of move with the duration vector. At least we have space. And if your risk is low, you can react more rapidly to the oncoming information. And so to your question, I guess, what do you do? I mean, I guess on a clean sweep, we kind of know what to do. It would be a bit more risk bullish, particularly if it's the asymmetry of a Republican clean sweep. But also on a Democratic one, just slightly different implications for growth. But on the rate side, probably curve steepener actually remains the way to play this scenario. It would be a bit more dollar bullish, particularly on a sort of clean sweep outcome, and so then you can engage with a dollar higher. But I think all of that is just too focused on this particular one event risk. I think it's important to take a step back and realize that there has been weakness in the jobs market, aside from the NFP number that we saw this month, and that number as well has a lot of sort of what's the best way to put it? It's a tricky one to ascertain. So one data point is difficult to get a full picture on the jobs data. Therefore, we look at all of the other sort of forward-looking components, and they are flagging some weakness on the jobs market. So that might come to play, I think, as we head into 2025.
Do you care much about earnings, especially with the banks, Ella, and trying to get a read just what credit conditions are in the U.S.?
I mean, we're seeing auto loans and credit card delinquencies rising. Also, credit card use has been coming off. So those are some of the warning signals. And I know because we're all in financial markets, we seem to be all in this bonanza of risk on and soft lending. These are things that worry me, and particularly as a bond investor, we always worry about anything that can go wrong, right? And so those are some of the elements that I would bring. I mean, there is nothing particularly concerning on the lending side from the banks yet. But you do see the other signals that are kind of flashing a bit red here.
Okay, Ella, we really appreciate it. That is Ella Hoja of Newton Investment Management. Enjoy the rest of your Friday and your weekend. I want to bring you some breaking news. The Nobel Peace Prize has been decided, and it's been awarded to a Japanese group of atomic bomb survivors, that group Nihon Hidankyo. Basically, they are an organization, just to quote the Nobel Prize, which we're looking at the award announcement there in Norway. They're giving the prize for its efforts to achieve a world free of nuclear weapons and for demonstrating through witness testimony that nuclear weapons must never be used again. That's according to the Norwegian Nobel Committee, saying in a statement. And so again, you're just looking at live pictures there of that announcement of the Japanese atomic bomb survivor group winning the Nobel Peace Prize. Okay, let's get to some other top stories that are trending on the terminal this morning. Warren Buffett has now cut his Bank of America stake to less than 10%. That's now below the regulatory threshold that requires quick disclosures of trades. That selling spree began in mid-July and went through 15 rounds of disposals. Berkshire Hathaway has now raked in $10.5 billion on that. Investors surveyed by Bloomberg are expecting China to deploy around 2 trillion yuan in fiscal stimulus. That's at their briefing on this Saturday. It's equivalent to about 280 billion US dollars. China stocks have posted their worst week since July in choppy sessions on expectations of that stimulus. Porsche is added to the chorus of pessimism coming out of Germany's automakers. It saw sales plunge around 20% in the last quarter to a 10-year low. That drop was led by EVs, with local Chinese brands continuing to grow in dominance. Coming up, we're going to have more car chatter, not just the weakness, but Elon Musk unveiling Tesla's long-awaited self-driving robo-taxi. And later in the hour, we're going to be speaking to Peter Scheer of Academy Securities on that confusing data picture. High jobless claims, but CPI coming in hotter than expected. What do you do with all that? We're going to discuss throughout the hour. This is your brief.
Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
It's your Bloomberg Brief. Danny Berger in New York here. Tesla CEO Elon Musk unveiled the prototypes of a much-awaited robo-taxi without a steering wheel, without pedals, called Cybercab at an event in California.
We expect to be in production with the Cybercab, which is really highly optimized for autonomous transport in probably, well, I tend to be a little optimistic with time frames, but in 2026.
Joining us at the latest is Bloomberg's Oliver Crook. Jessica Carl, Bloomberg Opinion, writing that it's Elon Musk's Cinderella moment insofar that he turned a pumpkin into a robo-taxi, and then at midnight it went poof and it disappeared. Tell us how real this dream of Elon Musk's of the robo-taxi, and when it's likely to even be put into production.
Yeah, well, listen, Dan, you're asking a lot of pointed questions, and there was not a lot of pointed answers on some of those points. So let's just actually go through what was actually presented yesterday. So the Cybercab, as you mentioned, was put out there. It's basically got no steering wheel, no pedals, going to be fully autonomous. This is all about sort of the future of urban transport. It's going to cost, he says, under $30,000. You can buy it as an individual. You could have it sort of working as a fleet, as a sort of Uber-style kind of situation. And they should be delivered, he said, by 2026, joking that, he's often very, very ambitious on these timelines. It'll carry two people, one of whom, as you can see, was Elon Musk yesterday on this sort of Hollywood lot, driving around this kind of invented scenario of the kind of his concept of the future. But there was also the Robo Van, which is this huge sort of van that can carry 20 people. It doesn't even have a windshield. It looks very sort of Blade Runner. And there was, of course, the humanoid robot, the Optimus, that Elon Musk was saying can make you drinks. It can do everything for you, mow your lawn. It could be your friend. And Danny, it could even babysit your kids, he said. Though, even as excited as one might get about the future, as seen by Elon Musk, I suspect people will draw the line somewhere.
Yeah, probably robots babysitting kids seems like a fair line, Oliver. Elon Musk said not that long ago that you basically need to be a believer in this dream to be a holder of their shares. I'm looking pre-market. I mean, we're down 6%. I guess not so many believers?
Yeah, so listen, Danny, I mean, this is all about sort of Elon Musk's sort of conception of the future. It's a bit sort of, a fantasy to a certain degree, but the magic of Elon Musk is sometimes being able to bring fantasy into reality, but we should say sometimes. There has been a lot of over-promising through the years, and as you can see, this investor's selling off this morning to the tune of about 6%. But for Elon Musk, as fantasy as this sounds, this is really at the center of his strategy. The backdrop here is that the sort of traditional growth engines of Tesla, all of these car sales, they've been falling sort of precipitously, and they said they were going to maybe sort of make a pivot and get a cheaper car to the market. They scrapped that idea, Danny, and they said, really, we're going to go sort of fully into autonomous. So even though it may seem sort of conceptual still at the moment, this is a very sort of serious part of the Tesla strategy going forward, and it's going to be absolutely necessary, Danny, to continue to sort of support that valuation, which is still at about $750 billion.
Oliver, I want to bring things closer to where you are in Berlin. Volkswagen reporting their third quarter sales in China dropping 15%. There are bad numbers from Porsche. We know Stellantis is shaking up its C-suite. Just how in dire straits are German autos at the moment, Oliver?
Yeah. In short, Danny, very dire straits. So we've had profit warnings from all the companies that you've mentioned, right? From Stellantis, we had that sort of profit warning about 2 weeks ago, which is what has led Carlos Tavares to have a massive shakeup across the entire company. New CFO, new COO, new COOs in North America, in China, new brand heads. That all came basically overnight. And guess what? The investors are still selling shares. Stellantis has lost a fifth of its value since that profit the profit cut. BMW, Mercedes, Volkswagen, same story. And really, when you drill down into the numbers, Danny, because we got the delivery numbers over the last 24 hours from all the German car makers, it's really a China story. We had BMW, for example, sales in China dropped 30%. Danny, when you put that into context, that is BMW's biggest market, losing a third. That is absolutely huge.
Yeah, and I mean, that's even without any discussion of what robo-taxis are going to do to the future of all these car makers. Oliver, we really appreciate your time this morning. Bloomberg's Oliver Crook in Berlin. Okay, coming up, we're going to bring you some of the headlines around the world. That includes Tehran's warning to the U.S. allies in the Gulf. All that to come on your Bloomberg Brief on this Friday morning.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control?
How does the current fighting completely stop?
I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Space, the next frontier of the tech sector. Today, Bloomberg Technology is live in LA for a special episode from Rocket Lab, featuring conversations with founders and investors of the companies plotting humankind's future outside of Earth's atmosphere.
We're going to get hands-on with the future of space technology, from rockets to robots.
Countdown to 11 a.m. Eastern, 8 a.m. on the West Coast, only on Bloomberg Television. Context changes everything.
The SBA is pretty right at the edge right now. And I think the Congress should be coming back and moving on emergency needs immediately. And they're going to have to come back after the election as well. Because this is going to be a long haul for total rebuilding. There's going to be a need for significant amounts of money. We're already underway at trying to calculate what the cost will be, because you don't want to mislead anybody. You want to make sure all the costs are able to be covered.
That was President Biden on the need for an emergency congressional response to Hurricane Milton. Let's go straight to ABC's Rena Roy, who joins us live from Florida. Rena, perhaps the worst of expected was avoided, but still not without damage. What's the latest there?
Yeah, Danny, well, I can tell you that here in St. Petersburg, this is one of the hardest hit areas. In fact, you can see that there's a crane into a building right behind us. And there are really scenes like this all across the state after Milton made landfall as a powerful Category 3 hurricane on Wednesday night just south of Tampa. And since then, there have been hundreds of rescues with catastrophic flooding across the state. The Hillsborough County Sheriff's Office going door to door on boats and in high water vehicles, rescuing more than 725 people. Nearly 500 of them were rescued from an apartment complex in waist-deep water. That building was not even in the evacuation zone. In Tampa, a mother and son even used their fishing boat to rescue people. In central and eastern Florida, it was really those deadly tornadoes. Milton spawned 38 of them. Hundreds of homes destroyed, at least 6 people killed. And as you just heard, President Biden, he is now calling on Congress to immediately pass funding for disaster aid. Danny?
Rena, what do we understand about the cleanup effort and just, you mentioned some of the rescuing, but the aftermath? I mean, you're looking at businesses, even the scenes just behind you of that crane into the building, quite shocking. What sort of resources does Florida have available to it to get the effort on the ground and get things back to normal?
Yeah, well, there is no doubt a very long road ahead here. The governor says this is one of the largest mobilizations of resources in state history. Local, federal, and state officials, they're all really working together here to try and give the people of Florida what they need to get back on their feet. We know that FEMA is also on the ground in force here. They have been offering resources like search and rescue teams, power restoration crews, and high water vehicles. Danny?
Rena, thank you so much for your coverage of this all week. That is ABC's Rena Roy. Stay safe out there. Okay, let's get you some of the front page news this morning, just a look at what's making headlines around the world. First up, on the New York Times, they lead with this, speaking of the hurricane, that bizarre falsehoods about Hurricanes Helene and Milton have disrupted the recovery efforts. There have been claims spread on social media, and that's despite attempts by scientists and government officials to debunk them. Experts warn disinformation and conspiracies can rapidly escalate into the real world and distract from aid. Part of the issue has been telling people, yes, there's $750 in aid, but there is more than that. Former President Trump also spreading some of that disinformation, too, about some of the aid going to immigrants, which, again, is not true in terms of FEMA. Next up, on the Wall Street Journal, Iran's secret warning to U.S. allies: do not help Israel or you are next. Tehran has been threatening to target oil-rich Arab Gulf states and other American allies in diplomatic back channels. The Islamic Republic has also warned that it would respond to any retaliation from Israel with devastating hits on Israel's civilian infrastructure. The Israeli cabinet met last night. Again, it's still a market that is in wait and see to see what will happen in terms of retaliation. Oil prices lower this morning. The Washington Post has this: Obama, former President Barack Obama, admonishing black men for hesitancy in supporting Harris. He made the appeal to black men specifically at an unannounced stop at a Harris campaign field office in Pittsburgh. For anyone that listened to this speech, it was quite fiery for those who heard it. Harris has also been struggling to mobilize the key demographic. Obama also in that speech basically saying that some of the disinformation that's been spread about Hurricane Helene really damaging and really pointed language about President Trump. Well, it is the hurricane, it is strikes, it is confusion in the data that has led to confusion in this market. The bond market yesterday rallying. Today, it is the opposite. Two-year yields, though, are still below 4%. We priced in more Fed cuts after yesterday's data that saw claims come in higher. It is the concentration of this market. The labor market data instead of the CPI. At this moment, a less than 20% chance that they do not cut at all. Is still the expectation is that they will cut in the next meeting. 10-year yields, those higher by 2.5 basis points. 30-year yields, 2.7 basis points. So it is the long end of the curve that is under pressure. Meanwhile, equities fall, on track to fall for a second consecutive day, coming down from the highs that we saw posted earlier in this week, down 0.2%. The declines this morning are being led by Russell 2000 futures, which are down 0.3%. The Bloomberg Dollars Index also taking a breather. It was on its longest winning streak since 2022. Coming up, we're going to catch up with Peter Scheer of Academy Securities just on that confusing data and what you do with it, and maybe why the market was paying too much attention to jobless claims data. Jobless claims data that have been skewed by the market, skewed by things like the hurricane, claims from North Carolina in particular picking up. Good morning from New York. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, welcome to your Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Autonomous dreams. Musk unveils Tesla's new robo-taxi, estimating production may start in 2026. The data puzzle, jobless claims at a one-year high and hotter than expected CPI. The Fed's next move remains in question. And earnings season kicks off. Big banks will report their numbers, JP Morgan and Wells Fargo, before the bell. It's a confused market, driven by confused data in a period heavily influenced by storms and strikes. Equities this morning are lower after lower session yesterday. Russell 2000 futures lead those declines. We're going to get some of the banks reporting today, JP Morgan and Wells. When it comes to this bond market, maybe more concerned by higher claims data. Yields go below 4% for your 2-year yield, though we are edging higher this morning, about 3 basis points for your 10-year yield. Now, that front end of the curve, just to zoom in on that, we got the jobs data yesterday, the claims data, and CPI. It was volatility initially to figure out what this market wanted to do. But ultimately, 2-year yields did end the day lower yesterday, below 4%. The concern, higher claims data coming in above 200,000. And maybe it was distorted, but it was what the market was questioning and concentrating on. Joining us now is Peter Shear, head of macro strategy at Academy Securities. Peter, you say it's a mistake for the markets to concentrate on the jobless data. Why?
Because I think last Friday's non-farm payroll was good enough that the Fed has really just looked at jobs. And now I think they have to start looking at inflation. And the inflation data, it's okay, but it's not great. And you start looking, okay, if China's stimulus is successful, what happens there? Oil's coming off a little bit today, but we've got geopolitical tensions everywhere that's putting pressure on oil. And then finally, I think the hurricane rebuilding is actually going to be inflationary for the U.S. One, it's disrupted some supply chains, but you're going to have a lot of insurance checks coming in. People want to fix whatever got broken. I think we're going to see a bout of inflation coming into the fourth quarter.
If we get a bout of inflation, is this going to be one of those periods like we had to start the year to say, okay, the Fed's just going to wait and see, they're going to ignore it? Or is it so bad that, especially adding in an election, a potential Trump presidency with more tariffs, as some have claimed, maybe it's even hikes on the horizon with all those factors?
So I don't think it's hikes. I think we get 25 bips in November. I think they're kind of set on that pace, and it would almost be embarrassing for the Fed to say, we did 50, now we're doing 0. So I think they get 25, but that puts us on this pause, and it is going to be data dependent. But I do think, one of my views has been, we really skew the data here because we use these 5-year moving averages to do the seasonal adjustments. We overstate jobs in January, February, March. We understate them in the summer. So it was not as good in the first quarter this year as it looked. It wasn't as bad over the summer. So I think we kind of meander through. But if the jobs data stays okay, inflation ticks up, the Fed's going to have to watch that.
It's interesting you say they're going to go 25 because it would look bad to pause. Maybe it looks like a mistake. Raphael Bostic gave an interview to the Wall Street Journal yesterday, and he said this choppiness to me is along the lines of maybe we should take a pause in November. I'm definitely open to that. Do you think this is Bostic And maybe others will follow, trying to set the stage to say, it's just because of the choppiness of the data. We didn't make a mistake, but we should pause.
So I think they're trying to set that up, but I think that's why we get 25, right? So they've certainly talked the market out of 50, which I thought was ridiculous. Like the market thought it was going to be 50, 50, 25. So the market's been moving my direction. I think the two things that are going to happen is, one, fewer rate cuts up front. So we get 25 in November, probably December pause. The other thing is they're starting to talk about the neutral rate. And I think the neutral rate's going to be more like 3.5%, 3.75%. Because if you look at it, right, we've been above 5% for a year and a half. The economy barely nudged down. So this thought that the neutral rate is somehow 2.875 or 3%, I think is wrong. And as they analyze this, what we're going to realize is fewer cuts next year, and the terminal rate's going to be much higher. I think it's going to be at least 3.5%. That's going to weigh on bond markets. So I think the 2 years probably okay, just around 4. I think we get back to 420, 430 on the 10s. And what's starting to make me nervous is I feel like the bond market, the liquidity is not what it once was. Everyone gets positioned one-sided, and now we're starting to move higher. I would have thought yesterday, after the 10-year auction, 30-year auction was done, we could move back towards 4% on 10s, and here we are at 409. So I think we could break much higher on 10s.
So we could break much higher, and then you've laid out all these risks on the horizon, specifically geopolitical tensions, and I know you have some of the brightest minds at Academy Securities, former generals analyzing this. What is the risk that you all see that there's a disruption in oil production and could lead to what you're talking about, that break higher?
Yeah, so we've got 20 retired generals and admirals who serve as our geopolitical intelligence group, so it's amazing that I get to work with them. And I think we're looking, and I think you're seeing it in the media, that Biden is trying to slow Israel down, but I think from a pure military standpoint, so ignoring everything we can on the humanitarian side, if you're looking at it from a military standpoint, Israel has a lot of things going in their favor. They have the proxies on the run. Iran has kind of shown itself to be a weak leader of the proxies. So we think they're going to continue to push on the proxies because they no longer trust Iran, right? They sent 180 ballistic missiles, nothing really hit anything of importance. And maybe they go after Iranian oil fields, right? That's the next thing, right? How do you stop the funding? Now that they've got the people on the run, so we think that's in play. And Russia-Ukraine's always there in the background. That's heating up. And there's a reality that maybe Putin or someone's going to want to create inflation ahead of the election. So I think oil's the way to play this. I think you want to be long at these prices still and buy oil. And I do not think treasuries are going to work as this quote-unquote flight to safety. Because what's happening right now is every time you get a geopolitical event, maybe you get a brief rush to treasuries, then people realize, oh my gosh, global spending on military is going to have to increase. Domestically, foreign, that's just going to put pressure on yields across the globe.
Not to mention the inflationary impact of higher oil prices. But, okay, so there could be oil disruption from Iran, but the big threat that everyone talks about is disruption in the Strait of Hormuz, is Iran attacking that Gulf supply. How big of a risk is that?
So I think from our military people say it's not a huge risk. They can disrupt it, but we have the tools, the ability to, sweep it out very quickly. So, but it would escalate, or there'd be the fight. But I do think you're right. We are much more focused on oil transportation than the oil fields themselves, right? Damage to the oil fields tends to be fixable. It's easy. We're looking at really the transportation hubs, the ports. I think that's where the real danger lies.
And so what oil prices are we talking here? Because it's the scenario, again, where oil goes higher and then you don't get that hedge of treasuries. I find that really interesting. So how high could oil go in this scenario?
So we kind of view, and again, we've been trying to play it in this range, but once you get near 90, I think that's about it, because the Saudis will flood the market at, we believe somewhere above 90, that's where the Saudis really step in. They keep oil supply going. So again, so long as they can ship it out there, and so far that's not our base case that they won't be able to ship it. So kind of 85 to 90 is where we kind of lighten up on hedges. 75 and below is where we buy these hedges.
Peter, before we let you go, we're about to get some of the big banks reporting. You mentioned bond market liquidity, but you've been excellent on stock market liquidity too, and some of the outsized moves in single name stocks. How are we set up into this earnings season?
It feels like we're going to continue to have these outsized moves. Like, you look at earnings and like, oh, that should be 2%, and all of a sudden the stock's up or down 10%. And sometimes it's both, right? It's up 10% initially, down 10%. So I do think there's very little depth of liquidity. I think all these algos drive things. I think that's one thing that happened yesterday morning. The algos are still kind of set to trade off the jobs data. They got it a little bit wrong, and I think over the next coming days or weeks, they'll start being re-triggered to trade off the inflation data. That's when I think this pushes through, and I think people are going to be surprised that China, the initial stimulus package looked meh. They are going to continue to push this. We think the CCP, to stay in charge, needs the economy to do better. They need to buy time for their Made by China strategy to grow. They're going to want domestic consumption to work. So we're going to see more and more stimulus out of China. So probably right now, my favorite stock market own is China via FXI, probably.
So I'm guessing you're going to be watching this Saturday?
Of course.
Okay, Peter, we'll get your take after. Peter, thank you so much for joining so early this morning. Enjoy the rest of your Friday and your weekend. That is Peter Scheer of Academy Securities here on Bloomberg Brief.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
It's Bloomberg Brief, Danny Berger in New York. We're somehow 25 days until the U.S. election. It's wild. Kamala Harris defended her record on immigration and health care in a town hall in Las Vegas. Donald Trump, meanwhile, is planning a string of campaign stops in states that he has little chance of winning, speaking at the Detroit Economic Club yesterday. Joining us now is Bloomberg government reporter Kate Ackley. Kate, what was the split screen we got of Harris and Trump yesterday?
Well, taxes and economic policy were front and center for both of them. As you know, this is an election where the economy, jobs, inflation, how much we pay for things is really right at the top for what people are concerned about, what voters are concerned about, especially in those battleground states. You saw Vice President Harris in Nevada talking about inflation and healthcare, immigration. You saw former President Trump in Detroit talking about offering a new plan that would sort of give a tax credit for car loans. Talking to Detroit about trying to help the auto industry.
Yeah, Kate, we actually have the sound to that. Let's just take a listen real quickly of what Trump was talking about for the car loans on the campaign trail.
Today, I am also announcing that as part of our tax cuts, we will make interest on car loans fully deductible. This will stimulate massive domestic auto production and make car ownership dramatically more affordable for millions and millions of working American families.
Kate, at this pace, there's going to be no taxes for anyone at any point. And you kind of understand that from Trump's pitch. I just wonder what audience he's going for, not just with these tax proposals, but in holding campaign events in places like Coachella in Colorado, at Madison Square Garden in New York, in the lead up to this election, places which are solidly blue.
Well, first of all, any of these tax provisions, these tax proposals, are most of them anyway, would have to get through Congress next year. So these candidates can, sort of propose all kinds of ideas. Will they resonate on the campaign trail? Maybe with swing voters. That's obviously the aim here, but they would have to get through Congress. And you got everybody, you got all the big, sort of surrogates hitting the campaign trail on, both sides. And you mentioned Trump going to Colorado tonight for a rally, and then later this month, Madison Square Garden in New York. Really trying to get into those blue states that he does not have much of a chance of winning.
Yeah, meanwhile, you can see there Obama was in Pittsburgh making a surprise stop with Harris, using really strong language. Kate, thank you so much for that. That is Bloomberg Government's Kate Ackley. Elsewhere, Tesla CEO Elon Musk unveiled the prototypes of a much-awaited robo-taxi. No steering wheel, no pedals. It's called Cybercab. He spoke at an event in California.
We expect to be in production with the Cybercab, which is really highly optimized for autonomous transport. In probably, well, I tend to be a little optimistic with timeframes, but in 2026.
Not just California, but at Warner Brothers Studios. Joining us now is Bloomberg's Global Autos editor, Craig Trudell. He says 2026. He kind of makes a joke about meeting deadlines. How seriously should we take this one, Craig?
I think we should take him at his word about being a little bit overly optimistic. I mean, just for a sense of how optimistic he can be. Some people were hoping that maybe last night we would see the next generation Roadster, and we saw a prototype of that way back in 2017 that was supposed to come out a couple years later. That is still not in production. So, and that is, of course, a car that, we humans will drive. So this is a CEO who is absolutely, superb at getting people excited about the future. But in terms of delivering on particularly self-driving predictions, he's really had a difficult track record there.
Well, to that point, Craig, we were just showing the Tesla share price down more than 5.5%. It was only in the beginning of this year that everybody was telling Elon Musk, you need to concentrate on having affordable vehicles, enough with this robo-taxi and Optimus dream. Is that still the case? Is this still an investor base and analyst community that wants to hear more about affordable vehicles?
I do think it's a bit split, right? Where we're seeing the auto industry, run into some trouble. We've seen profit warnings left and right from, the sort of old-fashioned metal-bending car makers. And Elon isn't very interested in competing with that. And there are some who say, you know what, he's doing absolutely the right thing by sort of zigging while the rest of the industry is zagging. But there are others who say, look, if this is a growth company that isn't growing, which it may not this year, it may actually sell fewer vehicles than it did in 2023. There are some who are very uncomfortable with the fact that, he talked years ago about offering a $25,000 electric vehicle, and that's nowhere to be found.
Craig, we also heard from the former President Trump yesterday, and he was very strong in his language in Detroit, talking about Chinese vehicles, stopping them from coming in the U.S. As part of that, he said the autonomous vehicle, we're going to stop from operating on American roads. Remember this. Maybe not clear whether he was talking about Chinese cars, but it comes at a time when Elon Musk has been getting closer to Trump and campaigning for Trump. How do we understand what a Trump presidency might mean for Tesla?
I think these are two characters who can sometimes, their words, you have to try to do your best to parse them, but it's not always clear just how much stock you should put into what they say. I do think that Trump has maybe sort of tempered his criticism of electric vehicles since Musk has endorsed him and become one of his biggest benefactors. I do think it was very interesting, though, that, within this, bit of criticism of Chinese vehicles and the Biden and Harris administration's handling of them, that he sort of, threw this aside at autonomous vehicles and sort of doubted whether people like them or are interested in them. I'm not sure whether he knew that Musk was, putting on this event a few hours later.
Yeah, unfortunate timing. Craig, we really appreciate it. Bloomberg's Global Autos editor, Craig Trudell. Okay, in other company news, big banks are facing tough questions as forecasts for earnings declines escalate. JP Morgan, Wells Fargo, they're going to kick it off with their results 7 a.m. today. JP Morgan President Daniel Pinto, in an attempt to reset expectations, spoke at a Barclays Financial Services conference last month.
The analyst consensus is a drop in NII of 1.5 billion, from 91.5 to 90. That is a bit, is not very reasonable because the rates expectations is lower by 250 basis points. So I think that number will be lower.
And that statement there led to lower share prices for JP Morgan at the time. Joining us now on What to Expect is Bloomberg's Shonali Basak. Shonali, after Pinto speaking there, just where is the bar for JP Morgan?
It is pretty high. If you think about it, you remember last quarter, they bought in returns of tangible common equity of 28%. Just stunning. But you see the market becoming more discerning because of a very uncertain outlook for net interest income. Now, it is the first quarter, right, that they were reporting after those Fed rate cuts. And what's interesting is the range of dispersion there is, both between how many cuts we actually can get and how that would feed through to net interest income, and how it would impact different banks differently. So for the sake of JP Morgan, for example, one reason that you saw Morgan Stanley really downgrade them is because they believe that they would be impacted somewhat negatively by that net interest income story, partially because they have so much of their income that comes from floating rate. So you will see how this plays out, but the guidance today for the rest of the year, if there were any upside there, that would be, of course, very, very positive, but people are watching credit quality very closely, too.
Well, yeah, to that point, because at that conference in Barclays, you had Ally Financial warning auto delinquencies are creeping higher, same with net charge-offs. Should we assume that that is a one-off, that is an Ally Financial story, or might that be more present in their earnings this quarter?
So it will be an interesting quarter across the board for all the banks for that reason, because we know that Ally Financial is not Fortress JP Morgan, right? It's not the same texture of loans under the surface. And if you take a look at kind of the FICO scores, for example, Bank of America kind of lays this out very, very clearly in presentations alongside earnings. JP Morgan, you have to go through other filings. But, these are very generally safe customers already. And so you think about the hit that's being taken here. Banks had been quite conservative the last couple of years. If we do see that tick up at JP Morgan, the deterioration here, you would see that impact across the banking system. JP Morgan has a very, very large credit card book, and so that is something consumers are watching very, very closely. As you know, the economic data has been very, very mixed, and so that will be a bellwether. We'll see how that plays out. But for JP Morgan, more so, one fun fact for you, Danny, I took a look at just last quarter alone. In net interest income, it was more than double of net interest income what they bought in total investment banking and trading fees. So that's how much that profit line really matters at the end of the day.
We're also going to get Wells Fargo today. What are you looking out for there?
Similar story, different kind of loan book here, and they don't have that massive behemoth credit card business as JP Morgan does. And so we have seen them really suffer from the lending business over the last couple of years. The question is, where do they drive that net interest income from? The other part of the story that we didn't talk about was the yield curve. The steepening is good for these banks. And so do they adjust their expectations based on the new projections?
I mean, it's so interesting to hear you talk about the yield curve making a difference for them, Fed cuts, and we kind of just don't know what this economic environment is. When it comes to forecasts from these banks, what does it look like in an environment where they just don't know, and then not to mention a U.S. election, which can completely change things in a month's time?
I think one thing that'll be interesting, this probably is a little less applied to Wells Fargo, though Wells Fargo has been trying to get more banking trading income here, more fee income. You had more volatility in the quarter than one might expect. And so did their trading desks really benefit from that or not? Because sometimes when volatility blows out that much, it's considered gapping volatility, where clients shy shy away rather than dive into the market. A little bit of a fun fact too, Apollo put out a very interesting note, Torsten's Lock, this week that said prime brokerage activity is starting to create a financial stability risk. And the reason that's so interesting as well is because these prime brokerages, the way that they have been kind of squeezing out that extra dollar is through their lending revenue. Goldman in particular has been leaning very, very into lending to their big institutional clients to drive that prime brokerage revenue and therefore to drive the trading revenue.
Well, it'll be an interesting quarter, to put it lightly. Shonali, thank you so much. Tune into Surveillance. Shonali will be breaking down those numbers 7 a.m. That is our financial correspondent and Bloomberg Open Interest co-anchor Shonali Bassick. Okay, coming up, we're going to set you up for your trading day. We're going to get you, Mitch, along with those earnings. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
It's your Bloomberg Brief. I'm Danny Berger. Let's get you set up for your trading day on this Friday. Bank earnings are going to kick off with Wells Fargo and JP Morgan. They'll both report before the opening bell at 7 a.m. We're also going to get more economic data. PPI at 8:30 a.m. UMich sentiment, that's at 10 a.m. And then plenty of Fed speak. It's been quite the week for Fed speak. We're going to get Austin Goolsbee, Lori Logan, and Michelle Bowman. Just some stocks to keep your eye on this morning. Tesla, we had that robo-taxi announcement. Disappointment, shares lower this morning. Uber, that's also rising off the back of Tesla's announcement. Meanwhile, Stellantis, they've ousted their CEO. They're trying to gain investor trust and stabilize its deteriorating business. Okay, that is it for your brief this morning. Stay tuned for Surveillance. That's up ahead.
what legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Inflation is still last year's story.
There really are no real problem areas underlying our data that we're seeing.
Right now, the evidence suggests it's an economy that's pretty resilient.
We've already realized a 50 basis point reduction. We're probably going to realize 2 more 25 basis point reductions this year.
We've got to reconcile ourselves to the fact that we've now got a normal, good economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now with your equity market shaping up as follows on the S&P 500. Equity futures down by 0.2%. We're off by about a third on the NASDAQ. On the Russell, the small caps down by about 0.5%. Still sitting very close to all-time highs with bank earnings just around the corner. The calendar for earnings on Wall Street shaping up as follows. Later this hour, JP Morgan and Wells Fargo. Tuesday, Bank of America, Goldman and Citi. Lisa, on Wednesday, Morgan Stanley.
And the focus is twofold. On one hand, it's net interest income and how much do the loans kind of end up performing less or delivering less as interest rates come down. And then there are the credit concerns. How much was Ally Financial really the canary in the coal mine in terms of credit concerns, credit deterioration coming down the pike?
JP Morgan already warning, essentially, that analysts were too optimistic around net interest income. That was Dan Pinto back in September, 0.1. Ally Financial, 0.2. Then we had David Solomon over at Goldman warning about trading revenue as well. So just lowering the bar going into these numbers.
With a complete lack of visibility. And that is what I've heard from a number of executives in the banking sector. You can talk about pipelines, but in reality, they dry up as quickly as they come out. And right now, there is just a complete lack of visibility about what actually will get done. How much does this have to do with the election? How much does this have to do with some of the geopolitical overhang that seems to be whipsawing some valuations, at least over the past couple of weeks?
Big story for us later this morning. Here's another one in the bond market. Yields just a little bit higher, up 2 basis points on a 2-year, on a 10-year up by about 3. Still north of 4% on 10s, just south of that level on 2s. But a big rally yesterday, particularly at the front end of the curve. Yields were down about 6 basis points. Still working through that economic data of yesterday, the wrong kind of upside surprise on both CPI and jobless claims.
Yesterday was a fascinating litmus test because essentially this was saying what's more important to this Federal Reserve, what's more important to this market? Is it inflation or is it the labor market? And what ended up happening is both were important, but for different reasons. What you saw was basically more rate cuts being priced into the market by the Federal Reserve because of what we saw with the upside surprise in the jobless claims. But on the flip side, longer-term inflation expectations ticked up. You saw that in the break-even rates. We're talking about potentially higher, stickier inflation over the long term with a Fed still willing to cut rates in response to a weakening labor market.
So let's just sit on the front end. What's more important to the market is what's more important to the Federal Federal Reserve. And there is this belief that jobless claims will be more important to the Federal Reserve, even if we can just dismiss them and talk about the hurricane effect. And I think that was reinforced, almost cemented by some of the commentary we got yesterday from Williams, Goolsbee and Barkin, all cementing the idea the Fed is comfortable with this disinflationary trend, just removing some of the emphasis away from that hot inflation print.
Basically talking about how a lot of data will move around, but they have confidence that they are gradually moving back down to that 2% level. It doesn't concern them. It doesn't move them away from necessarily cutting by 25 basis points. Raphael Bostic opened the possibility that maybe, just maybe, he might not want to cut rates in November. That's the reason why in the market you could see a little bit of skepticism with not even a full 25 basis point rate cut being priced into Fed fund futures.
CPI yesterday, PPI a little bit later this morning, 8:30 Eastern time. Look out for that data. Equity futures, as I say, pulling back by around about 0.2% on the S&P 500. Yields drifting just a little bit higher, up by 3 basis points, 4.09%. Coming up this hour, we'll catch up with John Stolfus of Oppenheimer, remaining bullish on equities. Melissa Seixas of Duke Energy, Florida, on the aftermath of Hurricane Milton, and Jared Cassidy of RBC as big bank earnings kick off later this hour. We begin this hour with stocks on hold as earnings season kicks off on Wall Street. JP Morgan and Wells Fargo set to report later this morning. Oppenheimer's John Stolfus writing, we expect investors to pay particular attention to the big banks this season for quarterly results and any guidance. That could provide greater clarity into the health of the US economy, what lies ahead, and how it might affect stock prices. John joins us now for more. John, good morning.
Good morning.
It's good to see you, sir. Good to kick off the morning with
Great
you.
to be here.
How low is the bar for these banks after the guidance we got in conference season a few weeks back?
You know, I think the bar is relatively low for the banks. I think there's an understanding that is beginning to flow through the markets that this is a period of transition. I think the numbers that we saw in terms of the economy from the July jobs number and then the most recent jobs number, the disparity betwixt the two, the inputs that are put into the economy, it's never very clear when you're coming into a transition, into a normalization, or whether you're getting into trouble.
Do you think these bank stocks can perform well with the implied rate path from the Federal Reserve and the SEP a month or so ago?
I think they can. And I think that banks today are more efficient than they've ever been before. It doesn't mean that you can't get a disappointing quarter. And I think the markets always, when they come in here, very often ahead of the reporting, the markets weaken somewhat. Then if we get some results that are better than expected, who knows what the traders will do? Will they say, oh, it's already done, and what's going? But generally speaking, you know, the financials have done very well this year. And a lot of that is the implication that things are getting better, even as things remain quite uncertain.
To build on what John was getting at, there is a feeling that, yes, it potentially becomes more difficult to make the same kind of net interest income as the Fed cuts rates. That doesn't seem to concern the markets as much as the Ally Financial issue. The potential of credit deterioration among consumers that might be beginning to feel the pinch of some sort of change in cycle. How much do you think that's really the concern that people have that could potentially shake some of the confidence?
I think that is one of the major concerns, but it's quite normal that you'll feel that concern at a time when you consider the Fed is what we had 11 rate hikes, 9 pauses at the high level before the first cut, and then questions related to inflation being stickier than may have been anticipated before, but likely the hurricanes are likely to ameliorate that somewhat. But overall, you know, what really has amazed me is, you know, 41 years in this business, I've gone through, I remember when Volcker was in his second term is when I came on, is that when you get to this kind of a point, I've never seen the consumers so sophisticated relative to other periods. And a lot of that could be the dissemination of information, the digitalization process of shopping and comparison shopping. I recall on a prior visit, we were speaking about consumer discretionary stocks and how within the retailers, you just have to pick the ones that navigate this current period better than other ones, whether they have greater buying power than the smaller discount stores or what have you. And the American consumer is remarkably resilient. The jobs number is resilient. Earnings have been resilient. Let's see how this third quarter comes out.
You know, as you're talking, I'm thinking of someone who we spoke to yesterday from Bank of America, who was talking about the resilience of the consumer and how you see ongoing spending in certain discretionary areas. In the past, historically, banks were a leading indicator for the other sectors that might be reporting earnings. Do you think this time around, if they're better than expected when it comes to consumer performance, they also will be sort of a leading indicator for the rest of consumer discretionary?
I think they should be. It's just that there are so many more inputs today than we've had in the past. And a lot of that has to do, again, with that resilience of business. So when you look across the sectors and you see what's working with consumers, and you look at the businesses that come in and out of favor quarter to quarter, sometimes day to day with the traders, but there's a general trend that's showing. There's an amelioration process, a digestion of the interest rates, and there really is a sense that people have more money sloshing around in their savings accounts in different places than many people have anticipated.
57.80 at the close yesterday.
Yep.
Your price target's still 5,900.
Well, it's
S&P.
Yeah, John, it's still 5,900 and will be until the S&P closes at or above it, because that's our discipline. That's our self-imposed discipline.
So help me understand where you want to be in the equity market with that in mind.
Yeah, with that, we wanted still cyclicals over defensives. It doesn't mean we don't own defensives, but we overweight the cyclicals. Continue to like technology, communication services. We like consumer discretionary, industrials, and financials.
Within cyclicals, let's just work through that. The financials, where do they fit into this?
I think the financials fit in because eventually we think that net interest margin is going to work for them. Once you get there's some volatility in the yield curve that occurs the way things are going in a transitional period. But once we settle to a more normalized yield curve, I think the banks, once the consumer feels more confident, we'll have to see what later on today we get the consumer sentiment number that comes out later on today. And it'll be interesting to see. But the consumer can be very emotional on those readings when the university reviews, does its surveys. Consumers can be pretty fickle. Remember, they warmed up for a while. The Conference Board was negative for a while, and they got warmed up a little bit. University of Michigan has gone back and forth.
Yeah, I love this. If they called me or you, John, they definitely would get emotions. We would sort of express how we feel about inflation going further out. I just want to finish with this idea of whether, if rates stay where they are, long-term rates, we're not talking about short-term rates, do you think that it favors one sector over the other? Do you think that it favors the ongoing cyclical kind of rotation that we've been seeing?
I think it does favor the cyclical rotation, and I think there's a realization that's beginning to come through. But it's still flowing through, is that we're not going back to see the Fed, unless we have a crisis, an unexpected crisis, we're likely not to go back to that band of 0 to 0.25, but more likely in an environment that'll keep the 10-year Treasury, at least near term, with all the changes that are happening in terms of the reindustrialization in the United States and in different countries, the process of diversification, of globalization, the expenses related to that. I bet you, in our view, we'd say that the 10-year will probably be in a range in terms of price to yield somewhere between 3.4 to 5 for quite a while.
Okay. Somewhere around that right now. John, appreciate it. Thank you, sir. John Stolfus there of Oppenheimer. I think we all agree on that. Nobody wants rates to go back to zero, because if rates go back to zero, we're in a bad place in the global economy. We get some numbers from JP Morgan a little bit later this hour. You'll hear from Wells Fargo as well. We just heard from BlackRock. Record AUM. Lisa, 11.48 trillion US dollars.
Which is sort of shocking. Think about how shocked people were about 8 trillion. That was about a couple of years ago. The estimate was $11.2 trillion. They exceeded that. What is most interesting to me, and this just shows how much money has flooded into U.S. equities in particular, Equity net inflows of $74.1 billion. The estimate, $29.5 billion. That just gives you a sense of how much this has exceeded this cash wall. Fixed income net inflows, $62.7 billion. The estimate, $58 billion. I mean, it just shows everything just exceeding that. And so they're capturing that picture from the other side.
It speaks to equities being close to all-time highs. On the S&P 500 right now, just a little bit softer, down by close to 0.2%. With an update on stories elsewhere with your Bloomberg Brief, it's Danny Berger. Hey, Danny.
10 people in Florida are dead and more than 3 million are without power following Hurricane Milton. Authorities warn it could take days to assess the full extent of the damages. They are cautiously optimistic, though, that it won't reach the levels of Hurricane Ian in 2022. Governor Ron DeSantis said Florida avoided a worst-case scenario, with the storm surge only half as high as forecasters had feared. AMD suffering its biggest stock decline in more than a month yesterday, falling more than 4%. At an event in San Francisco, it unveiled new AI chips. Investors, though, had also been hoping for new information on customers and financial performance. AMD has been emerging as one of the biggest challengers to NVIDIA in the AI processor market. Shares are up more than 11% this year. And John, as you mentioned, BlackRock pulling in more than $160 billion of client cash to its long-term investment funds this quarter. That means its AUM has been pushed to a record $11.5 trillion in assets, easily beating analyst estimates. They're now looking to become a one-stop shop for stocks, bonds, and private assets, benefiting from this year's surge in stocks and cash flowing into fixed income and private funds. And that's your brief, John.
Phenomenal numbers. Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, determining Hurricane Milton's damage.
Right now, we need to make sure that in the 72 hours after Milton has hit and it has departed, we have to make sure that people are really careful about trying to get back to their homes.
That conversation up next. Live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Earnings from JP Morgan, Wells Fargo later this hour could be about 30 minutes away. Going into it, the scores look like this. On equity futures on the S&P, down by a little more than 1/10%. Under surveillance this morning, determining Hurricane Milton's damage.
Right now, we need to make sure that in the 72 hours after Milton has hit and it has departed, We have to make sure that people are really careful about, trying to get back to their homes. They need to heed the warnings and communicate with local officials, because this is where we have a lot of deaths occur when the storm has departed.
So here's the latest this morning. Local and state officials assessing the scale of damage caused by Hurricane Milton. The state reporting at least 10 people were killed and 2.5 million residents remain without power. AccuWeather's Bill Waddell joins us now from Siesta Key, Florida. Bill, good morning to you, sir. What's the latest?
Good morning to you from a very dark Siesta Key. We are in one of those blackout areas with no power. This is where Hurricane Milton made landfall. You can hear the roar of the generators behind us, and sadly, you can see families' furniture out on the curb waiting to be picked up and heading to the dump for the second time in the span of about 2 weeks. Some of these families lost everything on the first floor of their homes, this storm surge and flooding damage here in Siesta Key. And what we want to point out is the tremendous economic toll that we are seeing from these back-to-back storms. AccuWeather has issued a preliminary estimate for the total damage and economic loss for Hurricane Milton, and we are looking at $160 to $180 billion in damage and losses.
And the cost is only going up. Bill, appreciate your time this morning, sir. Stay safe, as always. Bill Waddell there of AccuWeather on the latest. That cost is getting bigger and bigger and bigger.
And the difficult aspect is, how do you protect yourself against these storms when it's unclear exactly which aspect of them is going to be most damaging? With Hurricane Helene, it was the flooding. With this particular hurricane, Milton, we see that it's the wind as well. So how do you gird yourself at an infrastructure level for a multifaceted threat that is always somewhat of a surprise?
Let's talk about some of the power issues as well. Melissa Seixas joins us now, the president of Duke Energy in Florida. Melissa, welcome to the program. Fantastic to get some time with you this morning. We've talked about the power outages we've seen across your state. Can you tell us now how many customers are still without power this morning, and how long does it typically take to restore it?
As of this morning, we have about 845,000 customers without service across the 35 counties that we serve. The hardest hit county is Pinellas County, which is located between Tampa Bay and the Gulf of Mexico, just north of where Hurricane Milton made landfall.
Melissa, when you look at how long it takes to restore power, what position were you in coming into this after Hurricane Helene? Were you in a position where you had restored power to all those customers previously, or were you still playing catch-up even going into this?
We had completed our restoration for Hurricane Helene on Saturday. The hardest hit Barrier Island customers we were able to restore on Saturday. And by Sunday, we were already in full activation for Hurricane Milton.
Melissa, can you give us a sense of what goes into reactivating energy? Is it basically picking up downed lines? Is it rejiggering the circuitry so that you can redirect electricity to new areas? Can you just give us the sense of how much manpower is involved?
It does take a lot of all hands on deck, I will say. And so from a resource standpoint, it's very diverse, because we need line workers, we need a lot of vegetation management. You mentioned the wind takes down a lot of trees. We also need damage assessment, which was a really critical step in our restoration process that we began yesterday as soon as the sun came up. Getting eyes out in the field, both on the ground and from the sky, to help us determine the extent of the damage. And then that informs and shapes our work plans for each and every day. But we've got about 16,000 resources here in Florida to respond to our customers and get them re-energized. And we start with the most critical customers, hospitals, 911 stations, water plants, those kinds of facilities. But I want to really emphasize, we conduct damage assessment along with restoration at the same time. And sometimes it's actually not so much just re-energizing line, but it's rebuilding, especially with hurricane force winds from a Category 3 hurricane. But these are highly skilled workers. We focus on their safety, the safety of our customers as well. So concurrent to all that work happening, we are really stressing and emphasizing to our customers to remain very steadfast in staying away from downed power lines, always assuming that they are energized. So there's a lot of moving parts underway, and we expect to see a number of our customers restored today. And in fact, we will, by the afternoon, provide our customers with an estimated time of restoration so that they can make proper plans.
Melissa, I'm sure it's been an insane and exhausting number of days and actually weeks as you've been responding to all of the subsequent hurricanes. I'm just wondering, as you reset, when this is over, when power is restored, what does the business look to do to try to fortify some of the energy lines for the next prospective storm and the one after that?
We here in Florida are certainly in a constant state of hardening our grid. We're able to do that through what is called the Storm Protection Plan here in the state of Florida. So we have installed over the last handful of years a variety of hardening on our grid, from substation flood mitigation to converting some overhead lines to underground. Stronger poles, stronger wire. We have already seen that pay off immediately. I'll give you an example. In hurricanes Ian and Nicole and Adalia, excuse me, we were able to prevent about 200 million customer minutes of outages. So a lot of preventative outcome from these investments, and we will continue to do that. We take lessons from every single one of these events. As you mentioned, Helene was a very different storm in many ways because of the storm surge that it created up and down the Gulf Coast in our service area. This is the flooding you're seeing to the south of us, unfortunately. And Milton was very much a wind event as well. I mean, with those winds coming across as a Category 3. So we've seen a lot of poles down, wires down, definitely flooding in some areas. Fortunately for our service area, we did not sustain the significant storm surge that we had seen in Hurricane Helene.
Melissa, appreciate your time this morning. We know how busy you are, attempting to restore power to all those customers. Thanks for making time for us. Melissa Satius there, the president of Duke Energy Florida. I think your last question, Lisa, an interesting one for the long term. Do we have to rethink how we distribute power across many of these places?
Especially when you have potentially wind, you have potentially water. In some areas, you've got earth shaking. I'm talking about California. At what point do you have to fortify and harden all of these lines at the same time that everyone's saying that rebuilding the grid and building it out is actually the preeminent concern to making sure that we can advance technologically in the way that a lot of people are talking about?
Think how tough it's been for these residents over the last week or so. They'd only just restored power to all those residents over the weekend from Hurricane Helene, and then Hurricane Milton hits just days later.
Every single commentary, this is the worst case scenario. This is our nightmare. This was actually the bad situation that we were hoping to avoid. The one saving grace is that you didn't get another flood kind of come in some of the same areas in the same kind of way. But it really highlights, is this an aberration or is this a new normal? And what does that look like in terms of longer term planning for some of the regions that are going to be hardest hit? I also thought yesterday we had a really interesting conversation about the flood plans and how they are all dated back to the 70s. And how do you bring them up to speed so that we understand which zones are actually at most risk if something like this were to happen?
We saw jobless claims yesterday, maybe with a hurricane influence. I just wonder how long it's going to shake with the jobless claims we're still to see in the next few weeks, particularly for that payrolls report on November 1st. That one could be so messy after some of these numbers we've already seen.
And so at what point does the Fed look past this? At what point do we start to hear in some of the rhetoric from Fed officials like we did yesterday, our goal is to gradually move down, and right now, maybe data dependency looks a little different than it has in the past.
They're going to have a lot to confront come November 7th at the next Federal Reserve meeting. Up next on this program, Elon Musk unveiling Tesla's robo-taxi called Cybercab. We'll catch up with Bloomberg's Trey Trudell in just a moment. From New York City, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bank earnings in America just moments away. Numbers from JP Morgan, numbers from Wells Fargo, potentially in the next 15 or 20 minutes. Going into it, equity futures right now on the S&P, pulling back by 1/10% through Thursday, still on course for a fifth week of gains on the S&P 500, the longest weekly winning streak, going all the way back to May. In the bond market, yesterday was pretty confusing. A pretty bad data mix. Claims were soft, CPI was hot. So where'd you put the emphasis? You put the emphasis where you think the Fed will put the emphasis, and that's on claims. And the front end of this bond market made a move. Yields lower, a break of 4%, Lisa, 397.85 this morning.
Basically, the implication by the market and reinforced by a lot of Fed speak is that the Fed's going to put a greater priority, a greater weight on a jobs figure, and any sign whatsoever that there's any kind of weakening. What I thought was interesting is then you see, okay, inflation expectations tick up, so the long end should really rip, and we had a sense that maybe the auction would be a difficult one, the 30-year auction. Guess what? We had record foreign buying. We had record indirects. So basically, this was an incredibly strong, robust auction. Lots of people wanted to buy long bonds. Put that all together. If you're just as confused as I am, welcome.
Had a decent reprice of the long end, 1, 2. I think the beauty of bond markets is that the front end of the curve, the Fed has control over. That's basically the reaction function, how they respond to incoming information. That's what the Fed and the market were looking at yesterday. 1, 2, you can have a real debate further along the curve. If they're going to do X because of Y, what does it mean further out along the curve? And I think that's where the inflation conversation becomes a little bit more interesting.
And basically, people can't decide. They don't know. And that's what you see in Fed fund futures that are highlighting this sort of uncertainty. You see that with inflation expectations, break-even rates down the line, creeping higher. And then people saying, but I kind of like the yields. I'm not that worried. And so they go buy long bonds. Put it all together. It's kind of a soup right now as people look for clarity.
Let's get out of the soup and get into the FX market. I'm not sure if that's more helpful or not. Let's turn to foreign exchange. I want to look at DXY and look at how we closed yesterday. The dollar index closing stronger for a 9th consecutive day, the longest daily winning streak going back to April 2022. Just a little bit of weakness on the screen right now, but over the last week, some real strength.
Basically, what you're looking at is people pricing out the prospect of really aggressive rate cuts simply because the economic data has been so strong. I wonder how much this gets exacerbated next week if the ECB, as expected, cuts rates by 25 basis points and indicates that they're going to go further, because then all of a sudden it is the whipsaw opposite of what so many people expected just a couple weeks ago.
That meeting a week yesterday. So next Thursday, look out for that. Potentially a 25 basis point rate cut. To Lisa's point, the data's not been great. I'd be fascinated by what the excuse looks like at the news conference if they don't reduce interest rates. The dollar right now, just a little bit softer, down by not even 1/10%. Under surveillance this morning, China expected to announce the release of as much as 2 trillion yuan, or $283 billion, in fresh fiscal stimulus this weekend. A Bloomberg survey finding most investors anticipate the funding will come in the form of government bonds. The bar for Chinese officials getting higher, it seems, after the monster rally we've seen over the past few weeks.
What I'm most curious about is not the amount of money, not the headline amount, but where that money is put toward. Are they going to build more bridges to nowhere and support property valuations? Are they going to do some of the other fiscal expenditures that people are looking for? I wonder how much that's going to determine the sense of whether truly this administration wants to support the economy and engender some sort of domestic demand, or if it's sort of trying to make things look better ahead of next year.
The CSI 300 has been all over the place. It closed lower again today. Chinese equities down by about 2.8%. Elsewhere, authorities warning it could take days to assess the full extent of the damages from Hurricane Milton. The storm leaving at least 10 dead, and PowerOutage.us showing about 2.5 million homes and businesses across Florida remain without electricity. Elsewhere, Tesla CEO Elon Musk revealing prototypes of the long-awaited Cybercab robotaxi, but the presentation lacked technical details, with Musk hedging his bets on the leap to full self-driving and a production timeline.
We expect to be in production with the Cybercab, which is really highly optimized for autonomous transport in probably, well, I tend to be a little optimistic with timeframes, but in 2026. So, yeah, before 2027. Let me put it that way.
Craig Trudeau joins us now from Bloomberg. Craig, let's go through that line. I tend to be a little optimistic with timeframes, almost hesitant to say, but in 2026, so yeah, before 2027. How optimistic is that timeline?
Yeah, I think optimistic is putting it lightly, because, you know, just as a good example, I mean, almost 7 years ago now, in late 2017, we saw Elon take the wraps off of a next generation roadster sports car. We're still waiting on that one. So, and that of course is a vehicle that, you know, we humans will actually drive, and so, you know, it's kind of all manner of products that you have to be careful with Musk giving timelines. But I think particularly with respect to self-driving and autonomy, you know, this is a topic that, you know, really divides investors, where some are you know, keen to go along for this ride of his many promises that he's yet to live up to. Others are really nervous about the fact that he's sort of gone all in on this and done so at you know, at the expense of cheaper Teslas that the company desperately needs to grow again.
The stock is down this morning by close to 6%. I can't say that without acknowledging it absolutely ripped off the April low on the back of this announcement that we would have a robo-taxi day. It was up by something like 70% from there before yesterday. Craig, when you think about how much has been baked into this story, can you walk me through the competition and whether you believe this is a winner-takes-all scenario? We've got Waymo, we've got Cruise. Cruise has had its issues. We've got this, whatever it's going to be in the future, Craig. Who's in the lead right now?
That's such a difficult, you know, question to answer, because, you know, I do think when you look at, you know, what's actually on the roads and who's actually deploying, I think you have to say Waymo is the clearer answer. When you know, kind of take stock of how Waymo is getting there, and, you know, what the sort of state of the business model is, it becomes a little bit fuzzier, right? Because the cars that it is deploying are in, you know, select areas. They're very expensive, and that's always been, you know, Musk's sort of counter, right? Is this idea of you can't achieve this technological breakthrough that's going to be required without putting millions of cars out on the road that are all learning. And, you know, he's sort of making a bet that he can get there over time and turn those cars into self-driving, or get them to the point where we can check out, where we don't have to pay attention. He has not been able to actually follow through on that. And there are some real doubts as to whether or not he has the sort of hardware necessary to pull that off. And whether, you know, approach like Waymo's that is expensive for a good reason.
All I can say that Elon Musk did not really lay out, including would do very well. I am curious about some of the details that Elon Musk did not really lay out, including any kind of addressing the regulatory overhaul or regulatory types of frameworks that would be necessary to really get a self-driving fleet of cabs or cyber trucks or whatever. And the other question really is just whether they would oversee this cab system or this van system, or whether somebody else would. Which of those do you think is most important for investors to understand?
Yeah, I mean, there's sort of questions galore left unanswered by this event. I think it was, you know, it was you know, a slickly staged event, but that's what it was, right? It was a lot of theater. And I would say, in terms of, you know, answering your question, I would say the regulatory one is the most important here. If you look at another competitor in this space, Cruise, the unit of General Motors, they had a really hard time getting regulatory approval for a dedicated vehicle that they wanted to make called Origin. And you have limits as to how many cars you can make that don't have a steering wheel or pedals under U.S. law. And so the company ended up going in the direction of rather than making that dedicated vehicle, just sort of retrofitting an electric car that they already have in the market. And so, whether Tesla can avoid the pitfalls of what GM went through, Waymo has not tried to go down that route. They've retrofitted other companies' vehicles that have a steering wheel and pedals, even if they're not being used. So there's real questions as to whether or not they can sort of pass. This company can pass muster, and we know how Musk tends to deal with regulators, which is pretty in a sharp-elbowed way.
Craig, appreciate the update, sir. Thank you. That's one way of putting it. Craig Trudell there of Bloomberg out of London. That stock is down by something like 6%. The earnings this morning, JP Morgan, Wells Fargo, just moments away, both expected to report by 7 a.m. Eastern time this morning. Gerard Cassidy of RBC joins us now for more. Gerard, net interest income, the guidance that we're looking for from JP Morgan, how low is the bar for them that they reset themselves back in September?
It's interesting, John, that as you pointed out in September, they talked about the consensus estimate for net interest income for 2025. They thought was too high. And that number at the time, John, was $90 billion. Today, when you look at the consensus, our number included, it looks like it's 88 to 89 billion. So it's been lowered slightly. I don't expect JP Morgan to give us guidance on 2025, but during the question and answer period, I do expect them to be asked, what do you feel about the new consensus number? And I would not be surprised if they still say it's on the high side. So as you know, they did extremely well in rising short-term interest rate, that environment. And they have always pointed out, in a falling rate environment, their net interest income would come under pressure. And that's what we're expecting to hear today.
Gerard, who do you think it will benefit? When you start to think more deeply about the relationship between rates, what may or may not happen to the Federal Reserve, who will it benefit as well as hurt?
Yep, it's the $64,000 question, John, and it's the right one to ask. And I would say that it's going to benefit what we refer to as liability-sensitive banks. What that means is those are the banks that their funding costs reprice faster than their asset yields. And when you look at some of the regional banks, banks like Fifth Third or Truist, those are two examples of liability-sensitive banks. Bank America is also, as you might remember, when rates were moving higher, they had the long duration bond portfolio, and they were criticized for that, and the stock really didn't perform well. They too should probably see a benefit. On the asset sensitivity side, it's harder to say who's going to be hit the hardest, because if you're asset sensitive, your assets are going to reprice faster, and in a falling rate environment, you really don't want that to happen.
Gerard, it strikes me that there are a number of different banking issues that people are curious about, and they're not all going to affect each bank in the same kind of way. I'm just curious, based on the fact that we're looking at how interest rate income is going to really adjust based on rate cuts. We're also concerned about the consumer based on Ally Financial's warning. Which bank do you think is going to be most interesting, most instructive in terms of these trends?
Lisa, it's a good question, because net interest income is a very challenging line item, if you will, for outsiders to predict, due to the fact that there's so many moving parts. To your point, you have falling rates, or rates are changing. You could also see an increase in loan demand, which will impact net interest income. The banks also use derivatives to hedge this line item as well. So it's very challenging, but I think what you're going to find, to your question, banks like Wells Fargo, JP Morgan, both who are reporting today, Bank of New York already reported. These companies will give us good insights to what they're seeing in net interest income. And most of the banks have a good understanding. Regions Financial does a very good job explaining their derivatives portfolio. On the credit side, we're going to watch consumer very carefully, because we have to ask ourselves, was the Ally Financial warning on credit about a month ago, is that idiosyncratic to them, or is there a new trend developing? Right now, we think it's idiosyncratic to them, but we'll certainly hear about the consumer today from JP Morgan as well as Wells Fargo.
When those numbers drop, Gerard, we'll come straight back to you. Jared Cassidy of RBC is going to be sticking close. JP Morgan, Wells Fargo, just around the corner with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Warren Buffett can now take his time revealing trades in Bank of America. Berkshire Hathaway stake is now just 9.99% of shares outstanding, just below that 10% regulatory threshold that requires rapid disclosure. Instead, Buffett can now provide quarterly updates. Berkshire has reaped about $10.5 billion for sales of Bank of America. Even with recent disposals, Berkshire does remain the bank's biggest stockholder. A management shakeup at Stellantis. The car maker is replacing its finance chief. It's part of a broad management overhaul. CFO Natalie Knight will leave the company and be replaced by Doug Osterman. Knight, who joined the car maker last year, faced backlash over last month's profit warning. It came just a week after she characterized the company's full-year margin target as ambitious. Shares of Stellantis down 3.4% in the Italian trade. The Boeing strike now heading into its 5th week. The company is taking a harder line with union reps, filing unfair labor practice charges, saying the other side has bargained in bad faith and undermined its own deal. The union has said it's willing to talk, though Boeing, quote, needs to meet us at the table, and urged CEO Kelly Ortberg to insert himself more directly into the process. And that's your brief, John.
Danny, thank you. Up next on the program, earnings season kicking off on Wall Street.
I actually think the market is a little bit complacent on credit. I think that what they're pricing into bank stock is this perfect manifestation of a steep yield curve where deposit costs are coming down, loan growth is going to come back.
Results from JP Morgan up next.
about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Under surveillance this morning, earnings season kicking off on Wall Street just moments ago. Numbers dropping from JP Morgan and Wells Fargo. Shanali Basak with us around the table. Shanali, let's start with JP.
Well, first thing, you have JP Morgan's net interest income coming in above expectations. Remember, just weeks ago, they guided that the street was too optimistic for next year, but this year still looks good. However, the provision for credit losses also came in higher than expected. So here come the questions about credit quality. The quarter included $1 billion reserve build as well. So we'll have a lot of questions about that outlook. Remember, Jamie Dimon has been kind of warning about skepticism over a soft landing, worries about next year. But then you also have investment banking coming in higher than expected as well. Of course, JP Morgan, a behemoth in every major business line in investment banking. So that is a positive, especially because typically you don't get those deal fees until those deals close. So the fact that it looks this good right now is pretty positive.
Stock is up by 0.1%. This is always the case with JP Morgan numbers. The numbers drop. You've got to look at them, and then you've got to chase the squirrel that Jamie Dimon starts talking about. Large fiscal deficits are a critical issue. We'll get to the squirrel in just a moment. Lisa, let's start with the numbers themselves.
Yeah, what's interesting to me is that it's sort of the opposite story than what a lot of people expected. Net interest income actually came in better than expected. We also saw this pretty much in other areas as well, like BlackRock. However, the provisions for credit losses ticked up. And to me, the idea that it's the exact opposite problem. It's actually that Ally Financial, on the margins, was setting the tone maybe in a better direction or a worse direction, but a more accurate direction than some of the net interest income issues.
This is where things were set up coming into this. It was Ally Financial 1. It was the words of Dan Pinto 2. The words of Mr. Solomon over at Goldman Sachs as well 3. They'd all set the bar that much lower going into this report.
Well, remember also, JP Morgan heading into this report is trading at almost 2 times its book value, right? We're seeing pretty record levels of where its stock has been trading. And in addition to that, something to consider, and this is why they're setting expectations so firmly here, the returns on tangible common equity coming in at 19% is well over what was expected. It was 28% last quarter. And so this normalization and what you're seeing in profitability of the banks is pretty interesting, especially considering JP Morgan is the behemoth. There's one more point I'd want to make on this. JP Morgan, fascinating analysis by Morgan Stanley. A lot of their loans are floating rate. So as rates drop and as the interest rate picture changes, they're actually net, according to Morgan Stanley, a negative here because they would have a negative impact from those floating rate loans. When you see those provisions for loan losses starting to build, you start to ask more about those credit card books. We didn't ask about that a whole lot over the last couple of years, but people are maxed out on credit across the entire country. How fast does that turn?
You know, I have to wonder what's signal and what's noise. With credit build, that's partly also the executive management and how they're looking at potential risks down the pike as much as it is about current risks that are building. And so I do wonder if you pair JP Morgan with Wells Fargo, for example, where provisions for credit losses were below expectations at $1.07 billion versus the estimate of $1.34 billion, but they missed a net interest income. This is a motley picture that has to come down to execution and risk management expectation going forward.
Well, what's the cost of that net interest income, right? Risk. And so when you see them take those provisions, it's at the benefit of that higher net interest income, but then, you know, you have to make that income. You can't lose too much money on it. For Wells Fargo, they don't have that credit card book that JP Morgan has, right? That behemoth credit card book. By the way, Sapphire Reserve, right? A lot of these customers are not low-income, middle-income customers who have been struggling through this environment. They tend to be wealthier customers.
We've got Gerard Cassidy standing by over at RBC. Gerard, let's start with JP Morgan. What's your first take this morning?
The first take, John, is that the revenues are better than expected, as you pointed out, which is positive. The provision was a tad higher, but what's fascinating about the numbers is that the capital levels for JP Morgan are extraordinarily high. They have over a 15% CET1 ratio, common equity tier 1 ratio. As you guys have been discussing, their return on tangible common equity, very high. So overall, it looks like on the very first quick take, the numbers are slightly better than expected. And again, it will be more on the Q&A period during the earnings call that we'll find out more about that 2025 number.
Gerard, can you put this into perspective in terms of what this bank, JP Morgan, has done in the past going into periods of potential turmoil or lack of clarity? In other words, is this provision build something that is normal, something that is analogous to things that we've seen in previous years, or is this unusually large?
Actually, it was slightly higher than our expectations. We were at 2.9. It came in, it looked like at 3.1. And so it is a very interesting point, though, that you're making, because what we anticipate is credit costs are normalizing. We have to remember that following the pandemic, for a couple of years for JP Morgan and his peers, the credit costs were extraordinarily low. And when you look at the level of credit costs today relative to other time periods, they're very manageable. And the important part is what you expect for the economy in 2025. And so if you're anticipating a hard landing, then this could be the start of something. But we're in the soft landing camp. You saw the employment picture numbers over a week ago, very strong employment still. So we're in the view that the credit picture for JP Morgan and others is quite healthy.
I do wonder if this is a luxury of being the world's biggest bank, or if this is something that we're going to see repeated at other banks. Based on Wells Fargo, we saw actually provisions come in lighter than expected. How much do you attribute this to their not being able to lend maybe on the riskier side, or not being able to extend as much the way that JP Morgan does? And how much do you think that this just highlights that JP Morgan is sort of doing its own thing and sort of preparing for something that maybe other banks aren't seeing?
It's interesting because Wells, as you point out, they've got the asset cap that's still in place. And it certainly does make it more difficult for them to grow their loan portfolio. And therefore, you could argue that maybe their portfolios could be in better shape. But I'd point out a couple of things. First, commercial real estate, when you take a look at the deterioration we're seeing, it's been very manageable for Wells Fargo. And the other important point is that, the banks have been de-risked. Remember, they go through the stress test every year, and the regulators are very tough. So the industry today versus 2006 or 1989 or 2000, any of the periods where we went into hard landings, the industry today just doesn't have the risk that it had in those past periods. Now, don't get me wrong, we'll see some credit problems, but they're going to be very manageable this cycle, we think, because we don't see the hard landing over the next 12 months. But all the banks, I think you're going to see, Lisa, we're going to have good credit numbers, even though they're starting to normalize. But overall, we don't see any mass deterioration in credit.
It's a big theme to watch this quarter. Gerard, I appreciate your time as always, sir. Gerard Cassidy there of RBC alongside Bloomberg Sonali Basak. This number won't be lost on anyone. Lisa, full year net interest income. This is what JP Morgan's seen now, about 92.5 billion. They had seen at about 91.
These are incomprehensible numbers. These are massive, massive numbers that would be the luxury of any other institution or even government at this point. I am wondering how much JP Morgan's build of capital is just because they can. And so why not build a fortress that can withstand anything at a time of uncertainty and not necessarily a signal of any kind of weakening that they're seeing in the
Analysts were too optimistic, apparently, coming into these numbers, and then they just beat expectations across the board.
You love this game, don't you? Lower the bar, then absolutely blow it out of the water, celebrate it. Everybody's excited. You love it.
Drives me nuts. The stock is up by 1.8%. Up next on the program, Kevin Gordon of Charles Schwab, Bloomberg's Joe Matthew, Savvy Sith of Raymond James, and John Lovelo of UBS. We've got a lot to work through from New York City. Earnings season on Wall Street is underway.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Inflation is still last year's story.
There really are no real problem areas underlying our data that we're seeing.
Right now, the evidence suggests it's an economy that's pretty resilient.
We've already realized a 50 basis point reduction. We're probably going to realize 2 more 25 basis point reductions this year.
We've got to reconcile ourselves to the fact that we've now got a normal, good economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Earnings season is underway on Wall Street, live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. We've had numbers from JP Morgan, had numbers from Wells Fargo. The week ahead looks like this. You'll hear from Bank of America, Goldman, Citi, all on Tuesday. On Wednesday, you'll hear from Morgan Stanley. We need to start with JP Morgan right here, right now. I'll make it very simple. Net interest income, B. IB, B. Equity sales and trading, B. Lisa, fixed sales and trading, B.
With massive numbers that are off the charts, a real question here with net interest income at $92.5 billion versus the expectation for $91 billion. The one question mark is about the provisions of credit losses. A real question mark here about what JP Morgan is seeing down the pike, or do they just have the luxury of stockpiling lots of cash just in case?
So I said when the numbers came out, there's 2 things you have to do with numbers from JP Morgan. You look at the results, and then you start chasing the squirrel, like a golden retriever on financial news. Jamie Dimon's got this to say. Several critical issues remain, including large fiscal deficits, infrastructure needs, restructuring of trade, and remilitarization of the world. While we hope for the best, these events and the prevailing uncertainty demonstrate why we must be prepared for any environment.
So I spoke with Jamie Dimon this week, and what really struck me was his emphasis on his role as a risk manager. And what I find interesting is that JP Morgan has the luxury of being the ultimate risk manager, that whatever may happen, should there be nuclear war that breaks out, should there be some sort of massive spike in interest rates to 8%, or if interest rates go back down to 0, they need to be prepared. So there's this question of how much is this a luxury of JP Morgan to be an ultimate risk manager at a time of great uncertainty versus any visibility into something really massive coming down the pipe.
So this is a really important distinction. Often when we get these kind of words come from Jamie Dimon, people start talking about predictions of economic hurricanes and things like that. This is about putting a bank in a position to deal with anything.
That is basically the way he seemed to be framing it, that this isn't about something that he sees that we don't. This is about his job going to the board and saying, whatever happens, JP Morgan will survive. And so when we look at these numbers, it's important to wonder, is this really JP Morgan saying that this world is about to fall apart? Or is this a JP Morgan and a Jamie Dimon saying, look, we have the luxury of being the world's biggest bank, we're not going to fail, and we're going to make sure of that no matter what happens.
Based on these numbers, this world is not falling apart. This stock is up by close to 2% in the pre-market. The broader market looks like this. Equity futures just unwinding this morning's losses, just about unchanged on the session on the S&P 500. We'll keep one eye on the bond market all morning. Yields higher again after moving lower yesterday. We're up by 3 or 4 basis points. The 10-year getting closer and closer to 4.1%. Later on this morning, 8:30 Eastern Time, PPI. Look out for that after a hot and expected CPI print just yesterday. Coming up this hour, we'll catch up with Kevin Gordon at Charles Schwab as JP Morgan kicks off bank earnings. Savi Sith of Raymond James with airline earnings already underway. And John Lovelo of UBS as home builders face a devastating hurricane season. We begin this hour with JP Morgan kicking off bank earnings. Numbers coming in better than expected from that bank and not too bad from Wells Fargo either. Kevin Gordon at Charles Schwab writing, the soft landing is a process, not a destination. The US cannot be in a soft landing forever. At some point, the economy either goes back into a firm expansion or a recession. Kevin joins us now for more. Kevin, it's good to see you.
Good to see you. Good
JP
morning.
Morgan behind us, Wells Fargo behind us. Nothing to see here. Everything's decent.
Well, it's, never a nothing to see here thing. We've got the rest of earnings season to go. But I think that, the important part for earnings, maybe not just this quarter, but as we start to turn the quarter into 2025 is what does guidance actually look like? Because you look at estimates for the overall S&P 500 for next year, for next calendar year, they're pretty lofty. They're pretty elevated. And I think that becomes probably more of the needle mover in terms of this equity market, because when you look at, across an array of valuation metrics that we track, whether it's price to earnings, forward on a trailing basis, or it's price to sales, we tend to look at a sort of a blended growth rate of earnings, 4.5 years of trailing, versus, with 2 quarters of a look ahead. When you use that metric and you go back into the full history of the S&P, there's only 2 periods where you've been more expensive, and it was the late 90s and it was 2021. Not to say that we're about to repeat what happened after those periods, but there's not as much juice to squeeze out of that valuation or the multiple expansion part of this market. So I think earnings need to do a lot more heavy lifting as we turn the corner into 25. So that's why I think the guidance piece becomes important.
And yet here we are, JP Morgan beating expectations, even as the C-suite attempts to lower the bar only a month or so ago. Just how low is the bar for this earnings season?
You know what's interesting about lowering the bar or moving the bar is that when you go, nobody wants to go back to the pandemic, when we turn the lights off moment. But at that moment, rightfully so, companies at a record pace had withdrawn guidance altogether. And as we've gotten back to somewhat of a normal environment, there seems to be, sort of a more of a near-term bias in terms of companies letting us know where estimates are actually going to be. So there's not as much of this look-forward period where analysts can confidently say, here's what the estimate is, and we're not really going to adjust it more. There's a lot more of an adjustment going on as you get closer to the actual earnings results. So if that's the environment moving forward, which I don't think is a terrible thing, it just makes it a little bit harder to see where the bar is sort of in real time. I sort of think of it in similar terms for monetary policy and where global central banks are. I think because we're in a more supply-constrained and, a supply-constrained environment where supply shocks have become more frequent and a little bit more, detrimental to the global economy.
I'm just wondering, just to build on this idea of a lack of visibility and how the bar might be shifting around quite a bit. I mean, that's what we were just talking about with the idea of credit provisions, and every company is going to deal with that lack of visibility differently. As an investor, what do you do if an increasing number of companies don't give guidance or give you a huge range or just highlight the black box moment that we're in?
I do think it means that, in general, investors probably have to lengthen time horizons. It's just not as as beneficial anymore to be as near-term focused. And for our investors, broadly, we've got over 40 million clients at Schwab. So in general, we think it, tends to be, a better thing to lengthen time horizons. Of course, it depends on, your goals as an investor. But I do think that is the case moving forward, especially even if you just look at this quarter and the rest of this year, evidenced by some of the data that came out yesterday with jobless claims and what we're probably going to see for the October jobs report. Impacts from Helene, impacts from Milton, impacts from anything union-related or strike-related. All of that sort of makes the data into the end of the year pretty murky. And I think even for payrolls itself, we're in the survey period now for October payrolls. So if there is a bit more of a hit because of some of these shorter-term impacts from climate or from anything strike-related, you're not going to get a full picture of that until early December when we get the revisions for October.
What strikes me about what you just said is you need to lengthen your time horizon. It strikes me that visibility doesn't get so much better when you start talking about 2025. John's been talking about this a lot. It sort of gets incredibly cloudy with policy as a question, with the question of the geopolitics of the moment and what kind of inflation we end up seeing. How much do you have a longer-term outlook that is solid at a time of such binary potential risks?
I think it's more so lengthening in terms of being able to withstand volatility shocks, where you're not, you're not in an environment where you can readily, nobody can forecast perfectly, but you're not in an environment where you can readily see what these supply shocks are going to do on a short-term basis. And I think evidenced by what's happened over the past 4 years, where we have been in a supply shock-prone environment, whether it's the pandemic itself, whether it's what happened with Russia, Ukraine, whether what's going on in the Middle East right now, that's all really tough to sort of decipher in real time. So lengthening the time horizon means being able to sort of take a longer-term approach in withstanding those volatile shocks.
I'm going to shorten the time horizon aggressively through to year end, maybe the next couple of months. The average stock, as you've pointed out, is starting to perform just a little bit better. At the index level, even though we're grinding out record highs more recently, it's been a bit of a grind over the last few months. How do you change your approach when the average stock starts to do better, but the index level gains are a little bit more muted?
Well, it's fascinating because so far, almost to the first half, when you compare the first half to the second half to the day, when we flip the calendar the second half of the year, the market's activity has been almost the opposite, the mirror image of what happened in the first half. Where the first half of the year, you had all this churn and rotation, really aggressive rotation under the surface, but as you mentioned, now it's been a little bit more of a grind. I find it interesting that, when we were looking at all-time highs for the equal-weighted S&P, which preceded the most recent all-time highs for the cap-weighted S&P, that to me is actually indicative of a healthier environment. The fact that by the end of September, on a rolling 2-month basis, you had a record percentage of companies in the S&P 500 that were outperforming the index. On a trailing 3-month basis, it was close to a record. So there has been this really significant lift in participation and breadth and momentum down the cap spectrum in the so-called average stock, while the mega caps have taken a step back. It's almost the flip of the duck market that we were pointing out in the first half of the year, where everything was sort of looking calm on the surface, but then under the surface, you were sort of paddling like the Dickens. Now it's a bit of the opposite, where volatility has come up to the surface, and even though that's been rough at times, especially mid-July to early August, I think it's a better environment because it shows you that things have improved, in the X-tech or X-communication services part of the market.
We don't count record highs on the equal weight. It's just not that interesting to many people. Is it going to become more interesting? Are you seeing clients participate in that story, that theme, a little bit more?
I think it becomes interesting from the standpoint of assessing market health. I think most people still do look at cap-weighted indexes, but our message has been, and to your point, this grind higher, it's probably going to look less exciting at the cap-weighted index level than it would at the average stock level. But I think a lot of that is driven by the fact that, when you look at the bull market's about to turn, to technically tomorrow. First couple of years of this bull market, this has been the weakest run for equal weight relative to cap weight in history. It's been the worst run for the Russell 2000 relative to the S&P in history, and that's following a non-recessionary or recessionary bear market. So I think when you take that into account and the unique nature of this cycle, there is a lot more catch-up to do down the cap spectrum, even within an index like the S&P 500, all large cap companies, but not all have sort of been created equal in terms of their performance into the beginning of this bull market. So because of that, and I think in sort of alignment with our view that the economy is not slipping into recession imminently, there is more runway for those companies. But the differential between what's happened at the mega cap level and what's happened sort of in the average stock world is still pretty wide. So that catch up probably caps you a little bit and puts you in a more tepid gain situation for the cap-weighted index, but still puts you in, I think, a better situation for the equal-weighted index.
Some of us find it incredibly exciting when the equal weight reaches a new record high.
How many records this year?
What, equal weight? There are 44 on the S&P.
There you go.
All right, moving on. I do want to ask Kevin, just want to finish up here with this question about the appetite for risk among a lot of investors, which is another way of saying they care about the equal weight. I think, you know, you listen to Jamie Dimon, he's talking about large fiscal deficits, infrastructure needs, restructuring of trade, and remilitarization of the world. How many of your investors feel the same way and actually are a lot less bullish than you would want them to be over the longer term?
You know what's fascinating and been fascinating about this, the post-pandemic cycle that we've been in, and one of the many reasons that it's unique in nature and unlike anything we've seen, at least in modern history, is that there is at times this huge gap between attitudinal measures of sentiment and behavioral measures of sentiment, where on the attitudinal side, you might see folks or hear folks, and we hear it all the time because we're on the road a ton, saying, I'm quite bearish, I'm worried about this laundry list of items, the election being one of them, geopolitical crises being one of them, deficits and debt being up there as number one. But on the positioning side, they're not making as much adjustments. And I think that's really fascinating to me, because when you look at extremes in the sentiment environment, when you're in a bear market, and you go back to a period like June of 2022 when you had that first whoosh down in the bear market, there were almost a record low percentage of bulls in an attitudinal sense, but you weren't seeing it reflected in positioning yet. That didn't happen until the October low. So those points, I think, are important to distinguish, especially when we're in an environment like we are today, where people might say they're bearish, but when you look at the positioning and look at their equity exposure, it's still relatively high. Household stock exposure, depending on which metric you use, is right near an all-time high. So until that starts to change, then I think you can say that we're in alignment with sentiment, from a behavioral sense, lining up with what we've seen in an attitudinal sense. But I think right now, it's definitely something to worry about from an unsustainable perspective if you talk about deficit and debt, but it's not yet being reflected in what investors are doing with their money.
Thoughtful. Kevin, it's good to see you. Appreciate it. Kevin Gordon, a Charles Schwab there. The latest for JP Morgan, their stock is up by close to 2% in the pre-market. With an update on stories elsewhere, including the bank results, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Yes, some details on those bank earnings. JP Morgan and Wells both reporting, both shares up 2% for JP Morgan, 3% for Wells. JP Morgan's third quarter results beat across metrics. It upgraded its forecast for net interest income for the entirety of the year, too. CEO Jamie Dimon said the bank will maintain its pace of buybacks, with results backed by a strong balance sheet. At the same time, Wells Fargo did report a miss on net interest income for the third quarter, but profit was boosted by a 37% jump in investment banking fees. Former President Donald Trump is making a bid to boost the auto industry. In a speech to the Economic Club of Detroit, he promised to make interest on car loans tax deductible. He also promised to renegotiate the U.S.-Mexico-Canada trade agreement to prevent Chinese cars made in Mexico from crossing the border. He also took a swipe at his host city, saying the whole country will end up like Detroit if Kamala Harris is elected president. And this year's Nobel Peace Prize was awarded to a group of atomic bomb survivors in Japan. In a statement, the Nobel Committee said the organization was selected for the prize, quote, for its efforts to achieve a world free of nuclear weapons and for demonstrating through witness testimony that nuclear weapons must never be used again. The award comes with an additional prize of just over $1 million for the organization. And that's your brief. John.
Very cool. Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the cost of rebuilding.
There's going to be a need for significant amounts of money. We're already underway at trying to calculate what the cost will be, because we don't want to mislead anybody. We want to make sure all the costs are able to be covered.
That conversation up next, live from New York this morning. Good morning.
authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bank earnings underway on Wall Street. Just heard from JP Morgan about 20 minutes ago. That stock is higher in the pre-market by a little more than 2%. Lisa, it's a beat across the board.
Pretty much, with $92.5 billion of net interest income. I hear a huge question here about whether this is a bank girding for an upswing in the economy or a downswing or both. Basically, they have the luxury of doing whatever they want. So if they build more credit losses, is this really a sign for other banks, or just why not do it because we got the money?
Got to look for other banks. Tuesday, Bank of America, Goldman, Citi. Wednesday, Morgan Stanley. That's the calendar for the next week or so. Under surveillance this morning, the cost of rebuilding.
I think the Congress should be coming back and moving on emergency needs immediately, because this is going to be a long haul for total rebuilding. It's going to take several $1 billion. It's not going to be a matter of just a little bit. What we're providing now to make sure people have the emergency relief they need. There's going to be a need for significant amounts of money. We're already underway at trying to calculate what the cost will be, because we don't want to mislead anybody. We want to make sure all the costs are able to be covered.
So here's the latest this morning. President Biden urging lawmakers to return from recess as Florida faces a long road to recovery. House Speaker Mike Johnson's spokesperson saying coming back to Washington would be premature. Bloomberg's Joe Matthew joined us now from the nation's capital for more. Joe, why does Speaker Johnson's office think that it would be premature? What's behind that?
You know, he was talking about this on Sunday morning, Jonathan, saying that they need time to come up with estimates. As the president was just saying, they want real numbers here that they can write into legislation and present to lawmakers. And he suggested that wouldn't really be done until they could come back after the election anyway. But the calls are growing louder here, not just from Joe Biden. I spoke yesterday with Kathy Castor, a congresswoman from the district that includes the Tampa Bay area. She joined me by phone because she's one of the more than 3 million people without power. She's making that call, as is MAGA Representative Anna Paulina Luna. This one really got our attention yesterday. Also a representative from Florida and a Trump ally here says that Congress should go into a special session. We can get it passed immediately. This needs to happen. Speaker Johnson, call us back. So it's coming from both sides of the aisle here, Jonathan, and it'll be interesting to see how the speaker navigates this over the weekend.
Especially, Joe, because there's the dueling kind of priorities of people's lives, health and happiness, and politicking. I mean, how did they make the argument that campaigning and the campaign trail is more important than getting down to Washington and trying to provide some funding to help ameliorate some of the pain that people are experiencing down south?
Well, you ask a great question. I mean, what would actually be better as a campaign move than to go back to Washington to do the work of the people here? Because that is exactly what members are doing right now. They've got a weekend of events lined up in pretty much every district, town halls, and so forth, so they can get their names out there and do the campaigning that needs to be done. But we've got 4 weeks to go here, a little bit less than that. And obviously a trip back to Washington wouldn't take too much time. Again, it might be a week or two before we have real numbers on this, but a lot of experts say this could be handled before the election.
In the meantime, we've gotten a lot of town halls and different meetings and events by the two candidates, Donald Trump and Kamala Harris. What have they been saying in terms of the financing of this, especially at a time where tax cuts and the promises of them seem to be very much on the forefront?
Yeah, to be honest with you, we haven't heard a lot about funding from the two candidates here. Obviously, Kamala Harris is involved in the hurricane briefings and has been speaking from the White House as a member of this administration. But when it comes to the campaign trail, it's really been an argument about mis and disinformation with what we saw in North Carolina, to a lesser extent in Georgia and Florida. FEMA is out there trying to debunk rumors. You've got the President of the United States himself fact-checking Donald Trump live from the Roosevelt Room in the White House. I don't think I've ever seen anything quite like that. They're very concerned that people are not getting the help that they need because they're afraid of what they're hearing about FEMA, either confiscating property or selling them short on losses. This is something that runs across the Southwest right now and has been a real concern for people in Washington. FEMA says it not only needs money, it needs an honest shake so it can get help to people where it's needed.
Joe, something important developed on the campaign trail yesterday. It was the former President Barack Obama, and he started to go down a tricky road, and I think it's a very difficult path for Democrats to start going down. Addressing the misogyny within their own party. How are they going to do that in the days and weeks to come?
Yeah, I know where you're going there. That was pretty interesting, indicating that young black men might not be comfortable voting for a woman and pointing to polls that show that many young black men, in fact, favor Donald Trump. I don't know where you get on this. Barack Obama started last evening a series of events in Pittsburgh. He's going to be out for Kamala Harris over the course of the month. When she's asked about this, and she held a Univision town hall last evening, she has said, "I'm out here to work for every vote, and I make no assumptions based on my gender or racial identity here." So I guess this is going to be Barack Obama's job going forward. Unclear how it's going to work, Jonathan.
Joe, how simplistic do you think it is to put it down to misogyny and not policy?
Look, this has been a personality contest largely for a couple of weeks here. I don't have an answer to that question. You've got Donald Trump rolling out new tax proposals with 3 weeks and change to the election. Which one works? Which one matters? The fact is, they don't know. This is a one-point race or a tied race in every state, basically, that matters here. So both campaigns are trying everything they can to get to the middle. And it's pretty unclear how many people are left in the middle who have not decided.
Looking forward to your coverage, sir. A little bit later, Bloomberg's Joe Matthew out of Washington, D.C. You can catch Joe every weekday on Balance of Power at 12 and 5 p.m. Eastern Time. The former president going down a tricky path.
Especially because this is sort of one thing that Kamala Harris has tried to put on the back burner, making it not an issue about those things and making it more about policy. So does this help or hurt at a time when ultimately, do you want to be focused on policy? Do you want this to be a personality contest? There are a lot of difficult kinds of needles to thread at this moment just because these candidates are trying to cater to each specific constituency that all have competing potential goals and names.
We want to focus on policy, so we should focus on policy. There's been a few more being presented on the campaign trail at a time when we have a federal deficit running at 7% of GDP, even though unemployment is around 4% and GDP is running pretty well. It raises questions about what on earth we're going to do when it's bad. What does this deficit look like in bad times?
This is the reason why a lot of people keep raising the deficit and everybody shrugs it off and says, I'll worry about that when I have to. But you start looking at each item that, in particular, the former President Trump, because he talks about how you cut taxes when it comes to car loans, when it comes to if you're an expat, if it comes to whether you're a low earner or whether you're a high earner, whether you're a business. So it just raises this question of how much of a priority is this for the two candidates that are going to be facing off with a very difficult situation given the increasing entitlement payments, given the fact that interest payments are not going down that quickly, as we've seen from the long end of the yield curve, and as it's unclear that ever it's going to be politically palatable to say you're going to cut the deficit and cut spending.
Jamie Dimon is in the headlines a lot. The one thing that I walked away from your brilliant conversation earlier this week, the prospect of the Treasury market trading like a commodity market. If that happens, and you'll get tons of pushback in fixed income around that story, but let's just say, if it happened, if it started to correlate with the cycle in a more profound way, because ultimately, obviously, sovereigns, particularly developed market sovereigns, trade inversely to the cycle. If that started to happen, that would be devastating for the Treasury market, and I think for global markets too.
The concept here is that commodities are a supply and demand story, and that typically commodity markets don't trade until something happens, until there's a catalyst. And that increasingly treasuries are supply and demand story, and they may not be fully realizing the scope of just how much pain they could really suffer should there be some sort of catalyst.
That's what you buy in bad times. It retains risk mitigation characteristics.
Or does it?
Exactly. That's a big question. Up next on the program, Savvy Sith on the state of the airline industry from New York. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
2 hours away from the opening bell, equity futures down just a touch. We're softer, negative by 0.1% on the S&P as we count you down to the opening bell. With your morning movers, let's cross over to Danny Berger. Hey, Danny.
Hey, John. I want to get us a read on where bank stocks are trading this morning. For the whole, the sector is higher. Earnings this morning, JP Morgan 1.7% higher in the pre-market trade, a beat across most metrics. Investment banking, net interest income 3% higher than the year prior, where most banks forecast it being lower. They also upgraded their view of net interest income for the entirety of the year. The one flying the ointment, perhaps, is credit provisions higher than expected. Wells Fargo also higher in the pre-market trade, despite the fact that it missed on net interest income, up 3.33%. Not only did it miss on net interest income, it downgraded its view for the year, seeing a decline of 9%. Before, they had a range of a decline from 8 to 9%. Perhaps the thing helping it was investment banking fees, up 37% in the quarter, a beat for that metric. Finally, Tesla. It was Elon Musk over the summer that said, if you don't believe we'll solve autonomous driving, do not buy this stock. Maybe the verdict is in, down 6.2%, having their Warner Bros. Unveiling of the cyber taxi yesterday, saying that it would be by 2026 in production. Of course, joked about the timeline and his inability to hit some of those timelines. It would be less than $30,000. So again, shares down 6.2% in the pre-market because not a lot of detail in that report. Perhaps tellingly, both Uber and Lyft up decidedly in the pre-market trade, maybe seeing less competition for them from an autonomous driving taxi from Tesla. John.
Interesting. Danny, appreciate it. Thank you. After a monster rally, 70% off the April lows following that announcement for a robo-taxi event, we pulled back by about 6 percentage points in a pre-market on shares of Tesla. Under surveillance this morning, you heard the numbers from JP Morgan and Wells Fargo are out. They came out in the last hour or so. JP Morgan is higher in the pre-market by 1.5%. Wells Fargo is up by more than 3%. I want to share that quote again from Jamie Dimon earlier this morning. Several critical issues remain, including large fiscal deficits, infrastructure needs, restructuring of trade, and remilitarization of the world. While we hope for the best, these events and the prevailing uncertainty demonstrate why we must be prepared for any environment. You caught up with the man himself earlier this week, and that's almost exactly what you heard.
Basically talking about how he needs to manage risk, and this is a time of uniquely terrible visibility. Not saying that he actually thinks that the economy is going to fall off the cliff, quite the opposite. He's, still thinks that the U.S. is the best place probably for growth and for IPOs and for a whole host of other industries. A real question, though, about whether M&A will be allowed to come back in a real massive way, whether we get tariffs, what that will do, what national security provisions will do, and how this affects businesses that consult with the likes of JP Morgan in terms of what they develop and where. To me, these are all massive questions, and so you do wonder how companies are going to deal with that uncertainty. Will you see other types of cash build or hesitance to engage in big actions because of it?
And this is going to be the big question, corporate America. What does corporate America do? And then we can get into how the banks are going to serve them. Flying blind into 2025 has been a big theme for this program over the last several months. We're a month away from a really important election. And I think I hear the same boilerplate stuff on the South side that we always hear every time we have an election. Doesn't matter who's in charge, stocks go up, things are going to be okay, doesn't really matter, nothing really changes. Things could change in a profound way based on one outcome versus the other in a month's time.
Which is the reason why, and I do think about this, when people say it's all about the consumer, we hear person after person say the consumer is actually doing just fine. They have a stockpile of cash, et cetera. But when do businesses start to say, you know, we need to be a little bit more conservative? We're not going to engage in massive hiring plans. We've already seen that in some of the hiring numbers. We're not going to necessarily make a big move or attempt an M&A because we just don't know what that framework is going to look like. And when does that actually have an impact on the economy itself?
The latest from some of the big players this morning. More big banks, of course, reporting just next week. Elsewhere, let's talk about some of the Fed speak. Atlanta Fed President Raphael Bostic saying he would consider skipping a rate cut at the central bank's next meeting. Those comments going against remarks from Fed Presidents John Williams, Austin Goolsbee, and Thomas Barkin, all of whom indicated rates can continue moving lower. Bostic, the first to say the quiet bit out loud.
Basically, does this really call into question just how quickly and how much we have to cut rates? The interesting thing is, to your point, other Fed officials not saying it at all. And this is what Austin Goolsbee of the Chicago Fed had to say. The overall trend over 12 to 18 months is clearly that inflation has come down a lot and the job market has cooled to a level which is around where we think full employment is. Clearly, this is the key. Inflation was dead. It wasn't coming back. Now, are you starting to see a little bit of a waking up on the margins when you take a look at break-even rates on the long end?
Worth repeating something we've said earlier this week as well. Raphael Bostic is a really interesting Fed speaker to watch right now. They all oversee different regions, and the regional Fed presidents will oversee different impacts from the hurricanes. Atlanta Fed President Raphael Bostic is sitting right on top of that story right now in the Southeast.
Yeah, and a real tricky issue of just how much the jobs picture is going to be clouded by some of the hurricane influences. We already saw that potentially with the jobless claims, but also what this does to GDP, because ultimately you end up seeing typically growth fall off a bit in those regions and then surge as everything has to get rebuilt. So how do you price that in as a Fed official when you're trying to strip out noise and you're incredibly data dependent? You don't have a clear longer term kind of outlook.
You have no visibility whatsoever on the election and what policy looks like in 2025 and beyond. Let's talk about some of those policies. Donald Trump, the former president, pledging to make interest payments for car loans fully tax deductible in a speech at the Detroit Economic Club. Trump also vowing to renegotiate a trade deal in order to prevent Chinese cars made in Mexico from being sold in the United States. I think we have to separate two things: the policy and why we're talking about it, and then the price of it. And I think we should first deal with the policy and why we're talking about it. They will have to discuss this at some point in government on either side of the Atlantic. How are we going to help this industry? They are major employers, both in the United States and across Europe. And particularly in Europe, we talked about this. And we'll catch up with the Stellantis CEO next week. These car companies are in such a bad position in Europe. They have so much excess capacity that one of a few things needs to happen. You cut that capacity aggressively, that will mean job losses, not politically palatable, arguably not good for the economy either, or you get some help from the state. Now, the president, I think, opening the lid on a much bigger conversation that needs to take place, not just here in America, but also over in Europe.
Yeah, I'm glad that you brought up that angle, because that's what I thought when I read this. I thought to myself, wow, given that Volkswagen came out talking about China sales dropping 15% this morning, given some of the warnings that we've gotten from them, from BMW, from Mercedes, this question of what has to happen to sort of maybe put the thumb on the scale a little bit more for domestic vehicle sales and manufacturing. How much does a government want to get involved with central planning to counter central planning in another region that is doing it pretty efficiently, right? I mean, how much do you sort of get involved and do this? And then I would raise another specter of this, especially as we're talking about the idea of the fiscal deficit. How much room is there to do this? How much willingness will there be by bond markets to finance some sort of incentive program like that to try to get a competitive edge? I'm not so sure.
On top of all the other promises that are out there on the campaign trail right now, at the moment we're running a budget deficit of 7% of GDP in a good time and not in a bad time. Watch this space. Let's talk about earnings from American and United Airlines, still ahead after disappointing guidance from Delta in the last 24 hours. Savi Sith of Raymond James joins us now for more. Savi, welcome to the program. I'd love to get your thoughts on what happened with Delta and why it only took just a small miss, just the midpoint of guidance coming in below expectations to trigger a bit of a sell-off, particularly early on yesterday. What was behind that? Was the bar just a little bit too high going into earnings?
Hey, John, what I would say is, like, investors are finely tuned to try and figure out, what's happening with the U.S. airlines. You're seeing an industry that was struggling over this summer with too much capacity. And you've seen in very short order, as the summer ended, low-cost carriers and ultra-low-cost carriers moving quickly to take capacity out and match kind of supply to demand. And so what investors are trying to figure out is this having an effect? Is this enough that the industry has done so that we can get some margin expansion in 2025 for this industry? And Delta's guide on unit revenue from that perspective left a little bit wanting, and they called out an impact from elections, and so it's a little bit noisy here. And you know, the stock did recover a little bit, so I think investors are taking it in stride. But there was no clear signal if you know, this is enough changes have been done to drive that margin expansion next year.
Savi, that was a question asked in the newsroom much earlier this morning at a time that you don't want to be awake at. I think it was about 3:34 a.m. And we had people asking the same question, Savi. Was that an excuse, or is that something you typically see around elections? Was it just more pronounced this time around? What was that?
Yeah, you definitely see it around elections, and we've been calling about this year being noisy around, especially this kind of election period. But usually, it's within the fourth quarter, and you get a little bit of an air pocket. And if you look at what airlines have done, a lot of airlines have actually reduced capacity the week before and the week after elections in anticipation of this, and it just seems that what Delta is seeing, at least, is bigger than what we've seen in the past. So giving them the benefit of the doubt, they're saying that, you know, the trend, there's a clear break in trend before and after. So there definitely seems to be more of an impact this year than in the past.
Savi, when Delta catches a cold, does the rest of the airline industry have the flu?
Yeah, you know, it's a different position that the airlines are in. You know, historically, ultra low-cost carriers, low-cost carriers have been much more profitable than they are today. So if Delta is seeing weakness, then in this environment, I think the rest of the industry, especially on the low-cost and ultra low-cost carrier side, does see a bigger hit just because they're not as profitable as they've been in the past.
I ask this, Savi, because this has to go to the gap between people who have higher income and people who have lower income. And traditionally, we have seen that gap between Delta and, say, some of the lower income or the lower cost carriers. And I'm just wondering, do you think that that's the issue here? That this is just a matter of just discretionary spending across the board coming down? Or do you think that this is just having to do with structural gluts and some of the uncertainty that you were talking about that's temporary?
I think the reason the low-cost carriers and ultra-low-cost carriers are in a bit more of an unprofitable position today is just the fact that costs have gone up for this industry. You know, 6 points of margin have been wiped out just in labor costs. And so the ultra-low-cost carriers, low-cost carriers added a lot of capacity coming out of COVID, assuming that this was kind of like a normal recession-type recovery where you could take a lot of market share, and that was not the case. So I think with the airline industry, there's a slight difference here in that they just added too much capacity on the lower end. The industry as a whole, you know, it tends to be kind of middle income and high income households that tend to travel. It's definitely helpful to kind of Delta, United, that higher income individuals are doing better today. So there's a lot more demand for premium. There's a lot more demand for international. So that's definitely helping. But I think on the flip side, there's just too much capacity on the main cabin side, and that needs to kind of get right-sized and not necessarily related to household income spend.
The airline industry is fascinating to me, Savi, because you're looking at the potential vulnerability to different consumer trends, but also to different commodity trends. I'm looking right now at Brent crude, which is up $10 in the past month to currently $78.74 at a time when that's one of the biggest costs for a lot of these airlines. Just how vulnerable is this sector should there be an additional surge in crude prices?
Yeah, Lisa, the one interesting thing is while Brent prices hadn't come down as much, jet fuel prices had come down before last week. And what really drove that is refining margins have really normalized back down to 2019 levels, or maybe a little bit better than 2019 levels. So that has definitely given this industry some breathing room. You're right, it's about 25–30% of their costs. So what happens in kind of the jet fuel market matters for this industry. But at the end of the day, there are very few airlines that are hedged. And so the industry feels the pain the same way. And the biggest tool that they have is to then adjust capacity to kind of meet the new pricing environment that they have to kind of kind of aspire to kind of keep margins higher.
Savi, appreciate the update from you following down to earnings going into American and United for the next few weeks. Savi Sither of Raymond James on the airlines in America. Winning the morning, Glenn Score over at Evercore following BlackRock earnings, a record $11.5 trillion of AUM. Lord of the flows. Do you like that?
Oh, I love that.
Works, right?
That's so good. Honestly, I think that BlackRock, usually you sort of see their earnings and it's like, okay, a lot of it's passive flows. What can we get from it? The passive flows in and of themselves were fascinating. And John Stoltzfus, before he left, he said, you know, it's interesting because a lot of people aren't counting on Social Security being there. So they're saying, guess what? We're going to put our money into something that historically has been a provision of some sort of income. So that's stocks, that's bonds, and that's what you've seen in massive flows that absolutely blew expectations out of the water.
Based on how these campaigns are going, there'll be no tax base. So, yeah, you're damn right we're not getting Social Security.
That's what I find interesting. How much is that underpinning some of the flows that we're seeing in markets?
BlackRock in the pre-market up by 2.3%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Israel has stepped up its strikes on Beirut in its campaign against Hezbollah. Local officials said 22 people were killed in a strike on a residential building that was targeted a senior member of the terror group. The strike comes with the country yet to decide how to retaliate against Iran for ballistic missile attack last week. Israel's security cabinet held a meeting last night, but an Israeli official tells Bloomberg it ended with no decision made. One person was killed and 12 others were rescued after an accident at a gold mine in Colorado. Authorities say that an elevator malfunctioned around 500 feet below the surface, trapping the group for about 6 hours at the bottom of the mine. Those who were trapped did have access to water and means of communication. It's the first safety issue at the mine since the 1980s. Officials say that an investigation will be launched. The Yankees are heading back to the ALCS after taking down the Kansas City Royals in 4 games. Jarrett Cole delivered a vintage performance, holding the Royals to just 1 run and 6 hits over 7 innings. They're now set to face either Cleveland or Detroit in the next round, but that series set for a decisive Game 5 tomorrow. And that is your brief, John.
Danny, thank you. Appreciate it. Up next on the program, the rush to rebuild.
There are people lined up down the street and around the corner that will buy back in those coastal communities. It's amazing the type of land rush that happens immediately after a storm.
We'll talk about the home builders up next on the program, live from New York. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Earnings season underway on Wall Street. JP Morgan in the pre-market just off session highs, but still firmer by 1 full percentage point every way you look on this business. And the earnings that we got about an hour ago, just a beat across the board, Lisa.
I was looking at just even things like headcount, up 2% year over year, just to give you a sense of scope of how big this company is. 316,000 employees. That gives some perspective to the $92.5 billion of net interest income. These are pretty phenomenal numbers. A lot of focus will be paid to the look ahead, and I think that that's what I'm most interested to hear in terms of the analyst calls. What type of pipelines are they looking at? What type of expectation for businesses? The lack of visibility, I think, was really what came out to me when it comes to some of the credit cost build and some of the other commentary that we heard coming out of the C-suite.
One of, if not the, biggest private employers here in New York City. Equity futures right now, just a little bit softer. We're down 0.1% on the S&P 500. Under surveillance this morning, the rush to rebuild.
You will have all of those that saying, you know what, again, I've aged out, I'm going to move out. But there are people lined up down the street and around the corner that will buy back in those coastal communities. They will build up, they'll build to the higher building codes, and they will make the necessary investments to be able to enjoy what's beautiful about living on the Gulf Coast or the Atlantic Coast. It's amazing the type of land rush that happens immediately after a storm.
The rebuild starts right now. Here's the latest. Officials assessing the damage left behind by Hurricane Milton, while analysts begin weighing the impact on the housing market. John Lovallo of UBS writing, while we believe the storm could create a near-term headwind for home builder operations, we view any impact to construction efforts and demand as temporary. John joins us now for more. John, welcome to the program, sir. Let's just start from the top. Which companies, which home builders have the most exposure to this part of the country? One. And two, how much inventory would be at risk going into Hurricane Helene and Hurricane Milton?
Sure. Hey, John and Lisa, thanks for having me. Obviously, a devastating storm, and really two devastating storms, and our hearts go out to everyone in the areas. I mean, if you think about Milton specifically, we're talking about 7 of the top 50 home building markets that were in the direct path of that storm. And we're talking Tampa, Bradenton, Winter Haven, Orlando, Port St. Lucie. I mean, you name them, they're all sort of in that path. Now, the big home builders all have exposure in these markets. I would say that from the top, Pulte Group does about 5,000 units in those markets, so call it 17% of their volume. Lennar's at about 9,000, so call it 13% of their volume. And D.R. Horton is at about 10,000 units, which is about 12% of their volume. So very important markets, across Florida for everybody. Obviously, their portfolios are diversified well outside of Florida. And the important point that you bring up as well is, as devastating as this is, and the focus right now absolutely should be on the humanitarian portion. There is going to be an opportunity for all these folks to rebuild, and the builders will have a very nice chance to step in there.
So, John, there's going to be a rush for labor, for raw materials, which raises questions about the price of labor and raw materials. Do they have the pricing power to offset higher costs for labor and raw materials?
I mean, there certainly is pricing in certain markets across the country. Now, keep in mind that interest rates are high, home prices are high. The builders are offering incentives to get folks over the finish line in terms of affordability. So there could be pressure points for sure throughout the value chain. I would imagine that resources are going to be brought in from other areas to sort of fill this. To the extent that that drives up home prices, hard to say. Now, importantly, I think in areas like Florida in particular, the existing home stock, which is very old, we've talked about this on this program before, over 40 years old, the challenge becomes getting homes insured. And I think Jimmy, as you had on the program yesterday, was talking about building codes getting tougher and tougher and needing to get tougher and tougher in order to withstand storms like this. And I think that's where the builders have a real opportunity to put new product in the ground that is going to help withstand some of these tragedies.
When you're talking about all these new provisions, I'm just thinking cost goes up and up and up. I mean, you start thinking about insurance, you start talking about fortifications, you talk about stilts, whatever you need to do to try to prevent real destruction should there be another storm. John, at what point does this flip the script when it came to people moving to the Sun Belt, or in particular the Southeast? If you're talking about the increase in costs, people were usually going for lower costs.
Yeah, it's a great question, Lisa. I mean, at some point it becomes prohibitive, I would have to imagine. However, there are a lot of great things about moving into the Golden Horseshoe or the Sunshine States, whether it's just weather alone, but maybe more importantly is job growth. And that's where jobs continue to move. And there's a lot of reasons from an economic standpoint, but there's also a lot of reasons because people in general like to be in those areas. And this is a trend that was in place well before COVID. The builders will adjust. The builders will figure out a way to put product into the ground at prices that are affordable while maintaining margins and returns. We're very confident in that. Again, the focus now is on just us trying to assess the damage and hopefully hopefully things were a little bit less severe than initially contemplated.
John, you alluded to it. Can you just build on it a little bit more? The prospect of providing a insurance product in some of these areas. How do you think that might work?
That's a little bit out of my sweet spot, John, but what I would tell you from a home building perspective, it's no secret that in some of these coastal areas, whether it's Florida or even parts of California where there's been wildfires and things of that nature, it has become increasingly challenging and in some cases impossible to get homes insured. Now, for Florida and the storms, I think if you think about the older housing stock that's in the market today, that's even a bigger challenge because they just don't have foundations, the windows, the doors, and things of that nature that are built to this higher standard. And so I think that the builders, to the extent that they can do this, and they will, those homes are going to be in a much better place to get insured than something that's been in the market for 40 years.
John, appreciate your time this morning. Lots to work through. John Lovallo there of UBS on the latest with the home builders, particularly down in Florida. Some breaking news for you. So we've said this a million times. It's not really breaking news. Don't get too excited. The S&P 500 market cap weight, record highs so far in 2024, 44. Okay, a conversation we had a little bit earlier in the program, the equal weight argument I was making is the equal weight's not that popular yet because people aren't counting how many record highs we've had. Lisa, take it away.
Kevin Gordon, thank you for this. There have been 20 all-time highs in the equal weight S&P 500. So when you ask me next time how passionate I am about every record high, I will have a tally. I will make a sign. I will hold up that sign, and I will celebrate it with all my might.
You're going to be counting from now on?
Absolutely. Okay. Of course I will.
All right, okay. I'll ask for regular updates. Yeah. Up next on the program, Scott Croner of Citi, Bloomberg Sonali Basak on the latest bank earnings. We had Wells and JP Morgan a little bit earlier this morning. We'll look ahead to next week too. We'll catch up with Lara Rame of FS Investments with PPI dropping at 8:30 Eastern Time. And we'll speak to Leslie Falconio of UBS. All of that still to come in the third hour of Bloomberg Surveillance. With earnings season underway on Wall Street, equity futures on the S&P 500. With the smallest of bounces, we're still lower. We're softer by 0.1%.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issue, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
We do think we're still in a good is good environment.
The more important thing for risk assets is not whether rates are going up or down. It's what's the broader economic and earnings backdrop.
Maybe there's this narrowness creeping back into the market.
The market is sort of punishing the more expensive stocks for the higher rates. I think we're in a bull market, and peak inflation, peak tightening, peak rates should be good for equities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We are heading towards 5 weeks of gains on the S&P 500, the longest weekly winning streak going back to May of this year. Equities just off all-time highs coming into Friday. We're softer by 0.1%. The opening bound 90 minutes away, 30 minutes away, PPI. After CPI came in just a little bit hotter than expected yesterday. Futures a bit softer here across the board. We had bank earnings earlier this morning from Wells Fargo and JP Morgan. JP Morgan is up in the pre-market with basically essentially a beat across the board. That stock is up by 1.6%. Coming up next week, we'll hear from Bank of America, Goldman and Citi. On Wednesday, you'll get Morgan Stanley to round out earnings on Wall Street. JP Morgan kicking off earnings season on Wall Street in a pretty decent way.
If you look at investment banking fees, surging 31%. Take a look at equity traders, 27% increase. Net interest income, we've repeated this number many times just simply because it is rather incredible. $92.5 billion, up from the expected $91 billion. Across the board, you see net interest income up. You also see credit provisions along with some pretty dire statements from Jamie Dimon. He has been known to make such dire predictions. What's interesting is that they're stockpiling cash ahead of that. Is that going to be a theme for the other banks as well?
Another theme for the likes of BlackRock, Evercore calling them Lord of the Flows.
Love that.
$11.5 trillion in AUM over at BlackRock. That name up in the pre-market by about 1.8%. We'll talk about them into the opening bell, no doubt. Then the attention starts to shift, to drift Back to the economic data once again. A real toxic mix yesterday. Claims higher than expected. CPI just a little bit hotter than expected. PPI, the next stop for this market, about 28 minutes away.
You almost said it was a toxic brew. It was a little bit starting to have that flavor, a question of whether you care more about the inflation ticking up just a tiny bit or whether you care more about the fact that potentially the number that was the biggest jump in initial jobless claims that we've seen going back for a full year, whether that was telling you something other than just noise from the hurricanes. The bottom line is basically the market is saying both, that they're going to see a Fed that is going to look at the labor market, but longer term, potentially that could increase inflation on the margins, which is what you're seeing in terms of break-even rates.
Inflation just looking a little bit stickier. Coming up this hour, we'll catch up with Scott Cronin of Citi as bank earnings roll in. Lara Rame of FS Investments looking for the Fed to pause in the new year. And Leslie Falcone of UBS expecting a more bifurcated consumer in the near term. We begin this hour with stocks on hold as JP Morgan kicks off earnings season on Wall Street with investment banking revenue and net interest income beating estimates. Scott Cronin of Citi saying high level, the earnings setup looks solid. Better than expected beats and smaller than normal out-quarter revisions support our earnings resilience thesis. Scott joins us now for more. Scott, welcome back to the program, sir. Let's get into that thesis. Earnings resilience. Is that true for a couple of sectors, a handful of sectors, the whole market? Where's that theme a little bit more concentrated?
John, I think it's true pretty much across the board for every sector, maybe with the exception of the energy component of it. But generally speaking, yeah, it's the same scenario we've been talking for the past 2 quarters. We expect a very typical beat, if you will, with this quarterly reporting period. But there's still enough noise in the macros, geopolitical component of the market that we expect that most corporates will still be somewhat muted with their forward-looking guidance.
Scott, what's generating the beats? Is it better top-line performance, top-line growth rate, just doing a better job than we thought they would do at defending margins?
Yeah, I think you nailed it. I think it's a combination of those. I think we're still seeing a decent revenue component, but what's happening is that we're still seeing signs of margins improving, particularly at the EBIT level across most sectors. And what that's doing is creating this situation where, in addition, you're beginning to see free cash flow increase quite notably. What this does is open up financial flexibility. So where you get a little bit of a top line improvement, you get a better earnings beat, and then in addition to that, you begin to see corporates still flexing their muscles via share repurchase activity.
Scott, I just want to pick up on what you said about expect a lot of lack of visibility from corporate executives in the earnings in terms of a forward look. That's certainly what we saw on the margins just slightly from JP Morgan. I'm wondering at what point concerns about uncertainty become reality and a lack of investment, a lack of bold moves, how much you're expecting to see that from businesses that are kind of looking into the abyss of the unknown.
Well, our view on this, Lisa, is that we've been expecting that with the Q4 still containing a number of issues that we're going to need to contend with, and market up 22% so far this year. We do have to expect that we're probably going to get a dynamic where many investors and corporates are likely to be locking it in terms of their expectations for this year. As we look forward to next, again, we still have some uncertainty with the elections, again, geopolitics and underlying macro conditions that are still weighing on the conditions. But all told, when you think of the Fed influence over the past 2 years now, it's very fascinating that we've seen most corporates been able to weather 2 years of a hawkish Fed pretty nimbly, okay? So what we're looking at going forward is this component where, yes, that Fed overhang has probably kept most corporate investment activity somewhat muted. That begins to ease as we go into next year. But all told, what I keep coming back to here is that for 2 years of Fed hawkishness, the fundamental improvement through the S&P, particularly this year, is quite notable. And importantly, it's clearly broadening beyond the Mag 7 into, let's call it the other 493, which is how you're getting your incremental index highs here.
That's where I was going to go, actually. We were speaking with Morgan Stanley's Mike Wilson yesterday, and he was saying that he expects that to continue and that actually the places that he expects to be less impressive is probably in big tech that already have had such an incredible string of gains. Do you agree with that? Is that kind of what you're expecting this earnings season?
Yeah, okay, it's really interesting. So if you look at the Mag 7, they're trading on a top 12th percentile of their 20-year relative valuation history. The other 493 is actually more expensive versus this history right now than is the Mag 7, okay? So there's clearly an element here where the broader market is increasingly paying forward for ongoing fundamental improvement as we go into 2024. With the Mag 7 in this mega cap growth cohort, we probably have more visibility of earnings growth next year. NVIDIA is projected to grow 40%, the rest of the Mag 7 about 20%. On the other hand, Lisa, what's happening with that other 493, we still have not yet found bottom in terms of full year 24 estimates, nor full year 25 estimates. So while 25 is setting up for, we call it a high single-digit growth opportunity for next year, you're still seeing this right sizing of estimates under the surface that haven't yet quite found bottom. This is typical this time of the year. We don't think we actually get to that point probably to the Q4 reporting period. So all told, yes, this broadening effect is setting up for next year. A lot of it's getting priced in. That's what we have to be sensitive to, I think, in terms of the playbook into the end of the year.
Scott, if Anne-Marie was here, she'd start asking about the US election. So I'm going to do it for her. The corporate tax rate could drop to 15 with conditions. It could climb to 28. It might stay at 21. I've got no idea. Do you assign a probability to one over the other? What do you do with that?
Well, I think what I would say is that it's a frequent conversation in discussions with clients. You can't get away from the election potential outcomes right now. The race obviously is still quite tight. What we've been doing in terms of modeling this out is exactly as you say. When you look at each of the candidates, in our view, from a fundamental perspective, they're incrementally negative to U.S. equities. Okay, and what you have with Vice President Harris is the risk of a higher tax regime. But again, this requires a sweep more so than a split Congress. With ex-President Trump, we have to navigate tariffs, some talk of lower tax rates, and then a deregulation push underneath that. All told, the way we think it models out is that both are incrementally negative. What we're going to have to keep an eye on, and this is going to be a storyline as we get into 2025, is that, as stated right now, both policy platforms are mostly incrementally negative for the deficit as well. So as we go to next year, we expect the noise level around that to begin to pick up as well. So all told, we think there's lots of discussion around elections right now. I think many people are going to be waiting for post-elections to determine to what degree you want to begin to position for expected policy outcomes.
Let's just give you a hypothetical. Let's say the election happens and suddenly the bond market starts to trade a little bit more like commodities and yields go up significantly on the longer end because suddenly people start to wake up to this idea of a bigger deficit. At what point does that start to crimp some of the potential rally that we would get in equities?
Well, you see where this is setting up, Lisa. It's spot on. So we're using 5,600 for our end of the year target. We're through that now by a couple of percentage points. So we're allowing that we trade for the most part sideways into the end of the year with more focus under the index surface at the sector level. We can talk about the broadening theme to your equal weight as well. But our setup for 2025 is where we're looking for a more muted upside. So we're using 5,800 for next year. We have a bull case that gets us into the mid sixes, but that's going to require a more aggressive earnings picture than we're projecting right now. So what I would say on this is that coming back to this notion that, yes, we are paying forward for a lot of the expected earnings improvement, that's reflected in an index trading near 24 times trailing. So as you look ahead to next year, the risks that do come out on the policy side post-elections become a little bit more front and center. And what we think that does, when you combine it with the risk of the bond market vigilantes returning after a hiatus in expectation of this ongoing deficit concern popping up, what it does set up for is a little bit more muted upside to the U.S. equities as we go into 2025, despite a decent fundamental background and tailwind.
Can you put some numbers on what makes a bond vigilante? And I ask this because ultimately people have been wondering why yields have crept higher. Actually, they shot higher last week. And it didn't seem to matter for equities that continue to make record highs, including the S&P equal weight that made its 20th record high. How much are we looking going forward at a sort of change in the dynamic? At what point does that trigger some sort of risk-off feeling, even though it might not necessarily come in tandem with weaker data?
The issue that's going to come is the deficit continues to creep higher, right? And with higher interest rates, you get a different setup in terms of your interest expense burden as a percentage of your tax receipts. All of those right now are poised to move higher. Remember, we go into 2025, we're going to kick off with debt ceiling extension. And the expectation there is that that's going to happen pretty naturally, but it's going to begin to bring this issue back to the fore on the heels of the election again. The TCJA expires at the end of next year. So what we have to allow for is that we're going to have literally the better part of 25, regardless of who's in the White House, that we're going to be debating taxes. We're going to be debating how to address the deficit situation. And all of this is going to, I think, keep coming back to this. Now, the good news for equities is when we look at our projections, we expect that for the S&P 500, this is an important, nuance, to continue to reduce shares outstanding via buybacks by about a percentage point a year. So the supply of equities continues to come down. As fundamentals continue to improve, not a bad setup from a supply-demand perspective. You can't say that about the Treasury markets. We're expecting ongoing incremental supply of U.S. Treasuries that's going to have to be, consumed by the market. And that's going to happen in a context where we're looking at this geopolitical situation globally. And what you have here is a situation where the very strong reliance on the dollar maintaining its reserve currency component to essentially maintain the ability for the U.S. government to issue securities. All told, what I'm getting at here is that we think it happens in fits and starts beginning early next year and continues through the end of next year as we're kind of debating tax policy in anticipation of the end of that TCJA expiry.
Scott, a lot of layers to what you just said, and I think what you just said is so important. I myself am going to go home and watch this interview again and go to the very end of it, because there's an extra question I've got for you. If you get this supply-demand dynamic take place in the equity market, Lisa mentioned the bid coming from people who just believe there will be no Social Security for them. There will be no pension available for them. They'll have to take care of this for themselves in years to come. Can you describe this constant bid, particularly this passive bid that we'll just see in the equity market, this tailwind for years to come?
Well, I think we're probably setting up to see it for years to come. But, John, we got to be careful that we're coming on the heels of a very strong year-to-date equity market performance on the heels of last year's. So while I wouldn't say the equity markets are in a euphoric place, there's certainly a level of confidence out there that you need to be in the U.S. equity markets, okay? And you see this show up in the flows, and you've seen it particularly show up in the flows on the heels of the first Fed rate cut. We're talking about our ETF flow dynamics, and it's amazing the surge that's continued to go into core U.S. equity and growth equity exposures here. So there's no doubt that from a global investment perspective, U.S. equities, particularly S&P, are viewed as a very, very safe neighborhood to be moving into. So we expect that to continue, but we just have to keep in mind that we're being lulled into a security phase here, which has been warranted by fundamentals and by a peaking of Fed. And I'd go back to your earlier comments when you're looking